Hi, and thank you for joining us for our Precious Metals Royalty Conference. The financial markets have gotten hit hard in early 2022, with the S&P being down 5% in the month of January alone, making it one of the worst starts to a new year since 2009. With this recent market volatility as a backdrop, we've organized a conference outlining the benefits of gold and how gold exposure through a royalty company can benefit your investment portfolio. Before I introduce you to our presenting companies, let's first start with our expert speakers, beginning with Dave Iben of Kopernik Global Investors. Kopernik is an asset manager based in Tampa, Florida, and has over $7 billion in assets, 25% of which is allocated toward precious metals. Dave is going to share his views on gold and how he and his team value gold equities. Then we will hear from our second expert speaker, John Reade of the World Gold Council, which is the marketing arm of the gold industry. John will provide us with an overview of the supply and demand fundamentals of gold and where the price is going in 2022. Our first company speaker is Sandip Rana of Franco, Nevada. Franco, Nevada is the world's largest precious metals royalty company with 406 assets and will receive between 590,000 and 615,000 gold equivalent ounces in 2021. Franco's core assets are First Quantum's Cobre Panama mine and Lundin's Candelaria mine, and we will get an update on both of those operations. Then we will hear from Matt Fargey of Maverix Metals. Maverix Metals has a portfolio of 121 royalties and streams and has received 31,000 gold equivalent ounces in 2021. Maverix Metals' core assets are the Beta Hunt mine in Australia and Pan America's Silver's La Colorado mine in Mexico, and we'll get an update on both of those operations. Up next is Joseph de la Plante, the CIO of Nomad Royalty. Nomad has 17 royalty agreements and received 20,000 gold equivalent ounces in 2021. Nomad recently acquired a royalty on the Greenstone Gold Mine and Ivanhoe's Plant Reef project, and Joseph will provide further details on both assets. Then we will hear from David Awram, co-founder of Sandstorm Gold. Sandstorm has 230 royalties and streams and received 67,500 gold equivalent ounces in 2021. Sandstorm recently added an agreement on the Mercedes mine in Mexico and recently released a feasibility study on its largest asset, Hot Medan. Up next is Shaun Usmar of Triple Flag Precious Metals. Triple Flag has a portfolio of 78 royalties and streams and received 83,600 gold equivalent ounces in 2021. Triple Flag's largest investments are North Parkes mine in Australia and the Cerro Londo mine in Peru. Our last presenter is Randy Smallwood of Wheaton Precious Metals. Wheaton is the world's largest streaming company and has agreements with 24 producers and has provided gold equivalent ounce guidance of 735,000 to 765,000 ounces for 2021. Wheaton recently entered into agreements with Adventus Mining and Generation Mining, and Randy will provide an overview of both assets and agreements. If you have any questions for any of our presenting companies, send us an email to info@bloorstreetcapital.com, or you can write your question in the open chat on the right-hand side of your screen. Thank you very much for your support, and I hope you enjoy the conference. Dave, before we get your views on the financial markets, provide us with a brief history of Kopernik. When was the firm founded, and what is the investment philosophy of the firm?
Okay, really quickly, believe it or not, I've been in this business more than 40 years now. This is a continuation of what I've always done, investing in public equities with a definite pay attention to value. This was started over 8.5 years ago. Starting from nothing, now we've gone to, I think, 42 employees and roughly $7 billion in assets.
And now that 2021 is over with and we're into 2022, how was your performance in 2021?
Was all over the place. We started out well, had a bump, did well, and had a tough fourth quarter. But when you add it all up, we were up 20%, a tad above the All Country World Index that most people use. But in the fourth quarter, once again, it was all U.S., which we don't have. But we were happy with the performance, especially on the heels of a real nice 2020. And as we can get to later, things seem to be lining up pretty well for 2022. We'll see.
That's good. I want to get your thoughts on what's going to happen this year. But before we do that, you and your team are really bullish on gold and silver. And as a value investor, I want to hear your thoughts on this and why you are so bullish on the precious metals.
As a value investor, we think that outside of some pockets in EM and Asia, that metals are where most of the value is. So rather than say we're bullish on metals, I would reframe it and say, why is the market so bearish on metals? Why is it that gold's done nothing for a decade and gold stocks are down a lot? And why is it that uranium and natural gas and things like that are way lower than they were 14 years ago? So we're bottom up investors, so we can later on talk about the actual values we have on this. But the fundamentals have improved and the stocks have been dropping for a decade and a half. That's where the values are.
2021 was a great year for the broader indices, with the S&P up 25%. Many commodities had impressive moves also. Oil was up 25%, uranium was up 25%, lithium was up over 300%, but gold and silver were down in spite of record inflation and inflation levels we haven't seen in decades. How do you explain this lackluster performance in gold and silver?
Well, one thing we like is volatility. Many people consider that to be risk. We consider that to be opportunity. The fact that people hated gold back in 2002, but loved it in 2011 was a chance to buy in 2002 and sell a lot of it in 2011. Then over the last 4 years, it's mostly been opportunities to buy it really cheaply. But it's been fascinating to us how in any given year they like gold but hate copper, and the next quarter they like copper but hate palladium, or platinum used to sell at almost 10 times the price of palladium, and now palladium trades a lot above platinum. And so we've liked the fact that they've given us the opportunity to, a year and a half ago, be trimming some of our gold stocks and buying copper and buying natural gas and buying uranium, and over the last quarter or two, a chance to trim the natural gas and the uranium and the copper and go back into these gold stocks that are trading in many cases a fraction of where they were 10 years ago.
So on that point, gold is not too far away from its all-time high, but silver is nowhere near it. It would have to go up 100% to get to its all-time high. Why is silver lagging so much, and do you think silver will take out its all-time high of $50?
We don't know the future, but we do believe in fundamentals, and we believe that gold probably goes a lot higher, and that silver is cheap relative to its past, as you point out, and relative to gold. We would not be at all surprised if silver takes out its all-time high of 50. The first time it got to 50 was back in 1980. And then again, a decade ago. So look what the Dow Jones has done since 1980, what the Nasdaq's done since 1980, and silver's trading at half of that price. I mentioned earlier we actually like volatility. Silver and natural gas, being, as you suggest, in many cases byproducts, causes them to be even more volatile than gold and oil, which creates money-making opportunities. So you can have short-term overproduction, but in the long run, price eventually meets its fundamentals.
Dave, what do you say to those investors who are in gold and silver and who are frustrated with this lack of performance? Do you tell them to be patient?
We absolutely tell them to be patient. Always easier said than done. Although I'm really pleased with the client base we have. Having been in the business so many years, you expect clients to run out of patience, but we've got a great client base. They've hung in there. We also are thrilled that uranium's done what it's done, because 8.5 years ago when we started this, we started telling people we really like uranium. And the next year we're saying we still like it. The next year it's down further and we like it. Then it goes nowhere for a while while the uranium stocks keep going down. And we tell people, you know, the way we look at this is you can buy a 10-year bond and get 1% or 2%, or depending on the year it's in, and you've got a lot of clarity. We think the price of uranium is going to triple. We don't know when, but if it happens anytime in the next 10 years, you're going to make nice double-digit returns on uranium. Be patient, be patient, be patient, and they were. And a couple of our stocks from the low point to the high point were up 10x. And if you look back at 2016, some of the options-weighted gold miners we have also had really nice big moves. So with their patience on uranium and natural gas, it makes it easier for us to now tell them, be patient on these gold companies. We think the optionality is worth your weight. It's interesting to us, if you go to a healthcare conference, people will talk about prices are going up forever, and you go to a consumer conference and prices are going up forever. You go to platform companies and they have pricing power, prices going up forever, so on and so forth. Even in the metals, you go to battery metals and people will talk price going up forever. You go to a gold conference and you say, what do you think of gold? And they say, we're bullish. And we say, what are you using in your models? And they say $1,400 gold. Some are at 12. I don't think anybody's above 1650 that we know of. And yet the fundamentals for gold in terms of supply and demand, potential demand from all this proliferating currency, supply, nobody's building big mines here. Supply and demand argue for the price to go way higher. And yet the sell side analysts are using lower gold. The companies themselves are using lower gold. Everybody's using lower gold. And they put that in their model. And then they use a DCF on that, meaning any gold that's mined 5 years from now is worthless. We suggest that each passing year gives us a higher chance that the price actually goes up to its fundamental value. And as Lisa mentioned, people can reference our website. We've got a chart. We're happy to send you the chart too, showing the magnitude of difference between a DCF analysis and a Black-Scholes.
So Dave, that begs the question, where do you think the price of gold is going? I know you don't actually have a target price on gold, but you must have some idea in your mind. Does it go to $3,000, $4,000?
When it comes to commodities, we say they're volatile, but they eventually equal this equilibrium price, this price that will incentivize supply to come on. If you have too low a price of corn, people don't grow corn. Eventually, the price needs to come up to get people to plant it. So with gold, it's pretty clear to us it's trading below its equilibrium price. As we mentioned, when's the last time you heard anybody start on a major mine? There are some small ones here and there, but they're not getting built nearly as fast as remaining reserves are falling. So that price we imagine is $300 higher than where it's trading now, plus or minus. The stocks, as Elisa mentioned, are selling, so we think we make money even if gold stays where it is or drops a little bit. But a case can be made the price goes $300 higher, plus or minus. Now, a lot of people come to us and say, you know, gold doesn't have any use like a commodity. You know, you eat corn and you put gasoline in the fuel tank and burn it. You put copper in the industrial prices, but you don't do any of that with gold. we say, you're right. Gold doesn't sound like a commodity at all. It sounds like money. We don't eat dollar bills, and we don't put euros in the gas tank or put yen in the industrial process. So maybe the right way to value gold is looking at supply and demand of gold versus supply and demand of dollars and yen and euros and those sort of things. And on that sort of analysis, instead of being $300 higher, you can make a case for $3,000 higher. So we're bottom up. We want to buy these things, so we're going to make money if gold stays where it is now. But we look, how much might we make if it goes up 300? How much might we make if it goes up 2,000 or 3,000? And what we believe we have is little chance of downside with a chance of massive upside.
Dave, you are a bottoms-up value investor, and so is Warren Buffett and Charlie Munger. And as you know, they both dislike gold. And Charlie Munger has some amazing quotes, and one of his best quotes ever, and I'm paraphrasing now, but he said, even if you make money trading gold, you're still an idiot. What do you say to that?
Yeah, we're fans of a lot of the quotes from both of those guys, particularly Charlie. We like to listen to their quotes and agree with 90% of them. We like to look at their actions more than their words, just like we do with everybody else. If you look at their whole career, like us 40 years ago, they liked the fact that real interest rates were huge. Owning gold 40 years ago was arguably stupid. You had some measure of fiscal discipline in the world. You had real interest rates that were 1,000 basis points, and businesses do create value, and gold does not create value. So we have no problem with that. We'll point out a lot of things, though. Warren Buffett said he hated derivatives, but when the price was right, he bought derivatives. He hated junk bonds, and when the price was right, he bought junk bonds. He didn't want to issue debt, but at these interest rates, he has issued debt and continues to issue debt. They did buy silver once upon a time. They right now, and he's very vocal about that people are sitting on cash right now are stupid, that you should reinvest that. So if you take into consideration that for periods of time the dollar was a reasonable approximation of money, it wasn't as good as gold, but it somewhat held its value. At least you got paid 10% or whatever to hold it. So the right thing to do, and what Warren Buffett has always done, is say, I'm going to hold cash, and I'm only going to spend it when I get a bargain in the market. He famously sold everything except for the textile mill in the late 70s, returned the money, and said, I'm not going to invest now. Then a couple of years later, he invested when things got cheap. Now people have to go back, in our opinion, of thinking as gold is money. The central banks have made it clear that the dollar is not money anymore. And so I think people should hold gold unless they can find good businesses. They're going to make them a lot of money. Right now, we have the most expensive market, arguably, in the history of mankind. This seems like a time to sit on gold, despite the fact that it's boring, because as we've already talked, it's underpriced. And it's a way of protecting yourself from the dollar. And like I say, we see Warren Buffett trying very hard to protect himself from the dollar. And then the idea that you should only take gold or any other form of money and draw that balance to buy a business where you think you're going to get a nice return. You invest $1 if you think you get more dollars in the future. You invest an ounce of gold if you think you're going to get more ounces back. That's what we think we are doing when we buy gold miners. People don't even have to like gold to say, well, I can invest an ounce of gold into XYZ gold mining company, and I think I'm going to get back 4 ounces of gold for that. I think that is in line with the way Warren Buffett and Charlie Munger have always thought. You know, he may get around to gold again eventually. We'll see. I mean, he's smarter than we are, and it seems kind of obvious, more obvious by the day, that gold is something worth considering.
I want to thank you for sharing your insights on the financial markets today, and I look forward to our next discussion.
Well, our pleasure. It's interesting times. Enjoyed the conversation, and thank you.
Hi, John. Thank you very much for joining us today. How are things in London?
No, they're pretty good. We're getting back to normal here now, and hopefully the pandemic's behind us and we can all get back to the office and get to work again full time.
Let's hope so. John, 2021 was a great year for financial markets, with the S&P being up over 25%. Oil was up 50%. Copper was up 25%. But gold was down on the year, and I want to discuss why the lackluster performance in gold. But before we do that, why don't we just start with a brief overview of the World Gold Council and what its mandate is and who the members are.
Sure. So the World Gold Council is a member-owned organization. Our members are the most significant gold producers in the world, and it is genuinely the world. So North America, Australia, South Africa, China, some European gold mining companies. It's about 33, although I do struggle to keep track of them because they keep joining and then merging and getting taken over. But it's around about 33 members. Our mandate's very simple. We're there to grow gold demand and to improve accessibility of investors, of consumers of gold to the market. And to that end, we produce lots of research and data on gold. We have various tools on our website. All this information is available for free. We also work with central banks to encourage them to hold on to their gold, and increasingly over the last 10 years, reasons why they should buy gold. And then we do some public policy work too, in terms of opening the gold market up in certain countries. If necessary, we'll even partner to develop infrastructure to allow trading of gold, which we're doing currently in India, for example.
That's a great overview of the World Gold Council. John, why don't we move on now and look at the drivers of the gold price, which are supply and demand. And why don't we just begin with supply? What was the total supply in 2021, and where does the primary supply come from?
Yeah, I mean, and I'm going to be casting my eyes to the right at the spreadsheet from our gold demand trends, because we just published our evaluation of the gold market in 2021. We published that last week. And to make sure I've got the exact numbers from there, total supply for gold, about 4,700 tons last year. Now, most of that, as you can imagine, comes from newly mined production, about 3,550 tons. But recycled gold, and specifically recycled jewelry and maybe some technology demand, makes up about another 1,150 tons of gold. So those are the principal sources of supply for gold. There's some other technicalities there that come from the adjustments to producer hedge books, but basically, 99% of gold supply comes from either primary production or the recycling of old jewelry or old gold technology.
And why don't we move on to the demand side now? What was the primary demand in 2021, and what exactly was it?
The best way, I think, to think about demand for gold is to look at it over the last 10 years, because we do get fluctuations from year to year, and I'll talk about some of those, particularly in 2020 and then 2021. But over the long term, about 34% of demand for gold goes into jewelry. About 7% goes into what we call technology, so primarily electronics. So together, that makes up about just over 40% goes into consumer applications. So things that are very much driven by economic activity, wealth, prosperity, etc. But on the other side of the coin, we have about 40% of demand that goes into investment as well. And that investment's broken down into a number of different categories, exchange traded funds being one of them, but also bars and coins. So people going out and buying and taking physical ownership of small investment bars and coins as well. So together that makes up just over 40%. And then the balance of it, which I think has averaged about 17% over the last decade, is purchases from central banks. So central banks buy gold for very similar reasons to those of investors. They're doing it to diversify their portfolio. They're doing it as a store of value. And over the last decade, they've been an important component of demand for the gold market.
So given the supply and demand fundamentals, and you just mentioned 2020 was a very good year for the gold price, but 2021 was not. And how do you explain that?
Well, there's a number of ways of explaining it. And if I start from first principles, we've done a lot of work modeling the gold market and its influence on the price over the longer term. So we've got a valuation model which is available on our website for free, and you can go and fiddle with it. But generally speaking, if you put in more or less consensus estimates of growth and other macroeconomic factors, you find that gold should deliver on average over the long term US dollar returns of around 5% per annum. Now, that doesn't mean you're going to get 5% every year, obviously. And one of the things that you can observe is if you look at the performance of gold in 2020, when it was one of the best performing asset classes out there, delivered about 25%. So the fact that it was down through the year a couple of percent, although actually the average price for 2021 was actually 2% higher than in 2020. So it wasn't a terrible performance, but it certainly wasn't a repeat of the stellar performance that we've seen in 2020. And to a certain extent, you'd expect that. Another way of thinking about it is to think about what drove the gold price in 2020. That was driven very much by investment demand, by people who were looking to protect themselves or profit from the slowdown in the global economy caused by the coronavirus pandemic. And that trade worked well. People got good returns. Gold peaked in the beginning of August, traded sideways, and then started to decline into the end of the year after we had some very good news about the vaccine trials that were coming out, if you cast your mind back to November last year, November 2020. Now, what we understand to be happening based on conversations with investors is that a lot of investors who had positioned themselves in gold, overweight in gold, let's say, in the early part of the year, as soon as they could see light at the end of the tunnel, started to take money out of gold and buy assets that would perform well in a recovery. So commodities, equities, etc., all benefited from these flows. And if you look at the performance in 2021, the assets which had lagged badly in 2020 did really well. And gold, which had been, as I say, one of the best performing assets in 2020, was near the bottom of the pile in terms of relative performance. So I think that explains a lot of the reasons why gold didn't perform so well in 2021. You know, people say surely it should have done better in the inflationary backdrop that we saw, particularly late last year. And I'd argue it did do well, except it did it in 2020 in anticipation of that inflation. And for much of 2021, it was the reflation trade, and other assets tend to do better at that point of the cycle.
Interesting. I want to move on now, and I want to get your thoughts on Bitcoin. Bitcoin is often referred to as new gold or digital gold. And at its peak, Bitcoin had a market value over $1 trillion. It's pulled back quite a bit here in the last few months. But even with this pullback, Bitcoin was still up 60% in 2021. At the same time, gold was down. What are your thoughts on Bitcoin, and has it become a replacement for gold?
Well, it is described as digital gold or new gold by the enthusiasts of cryptocurrencies, but I'd say that the two are very different. I'm not here to say whether crypto assets are good or bad. That's not my job. I mean, I work for the World Gold Council. I'm here to talk about gold. But what I can say about crypto assets, and particularly Bitcoin, Ethereum, etc., is they're very different from gold. Yes, both have performed well over the last 10 years. And if you look at the impact of putting either some gold or some crypto assets into a diversified portfolio over the last decade. Both have increased the risk-adjusted return of that portfolio, but they've done it in very different ways. Gold's a diversifier, particularly a diversifier of equity-like exposure, and it increases the return and decreases your volatility. If you look at what Bitcoin and the other assets are, they're much more correlated with equities, and particularly over the last few years. So yes, adding Bitcoin to a portfolio has increased your returns, but it's increased your risks as well. And that shows that they're really very different propositions. Now, there are some fundamental similarities between Bitcoin and gold, particularly the artificial scarcity, which has been written into the code of Bitcoin. But other than that, if you look at the demand characteristics of both assets, as I pointed out before, in the case of gold, you've got a selection of demand applications, whether it's on the consumer side, whether it's on the investment side, whether it's on the central bank side. Whereas, to be honest, if you look at crypto assets, they're basically there for investment and speculation, particularly only. There's not very many use cases really for Bitcoin, particularly when you can only transact maybe 5 trades per second with the limitations of the network. So look, I think crypto assets are fascinating. I think they're incredibly volatile and more likely to stay volatile. There's big regulatory question marks over them, but I can see why people are interested in them, because they have given you decent returns most of the time. Sometimes it goes quiet, sometimes they deliver negative returns. But it's very different from gold, and indeed other hard commodities, I would say, as well.
John, you worked for a major U.S. hedge fund, Paulson & Co., who was and still is a big believer in gold and has many significant investments in gold equities. Why aren't other large hedge funds in the U.S. or throughout the world, why haven't they gotten behind gold the same way Paulson & Company has? And I guess to once again bring it back to Bitcoin, so many of these hedge funds have gotten behind Bitcoin, and I'm thinking about not just hedge funds but also investors at large, Elon Musk and Michael Saylor and Mark Cuban, Paul Tudor Jones, and we really haven't seen the same sort of enthusiasm for gold that we have for Bitcoin and cryptocurrencies.
Yeah, it's certainly an interesting question. One of the things I would say about crypto assets is they're very closely followed. And because investment and speculation are really the only drivers for it, the market tends to get very excited when large investors announce that they have purchased crypto assets, Bitcoin in particular. I can't talk about individual funds, and particularly those I used to work for, as you can imagine. But it is fair to say that there is considerable hedge fund interest in gold. Many of the macro hedge funds that you could possibly mention have positions in gold regularly. Sometimes long, sometimes short, and sometimes they're out of the market as well. So they'll look for opportunities where they see them. I would be astonished if there weren't substantial long positions held by hedge funds back in 2020. And I wouldn't be surprised, to be frank, if most of those positions had exited by the end of the year, simply because of looking for different opportunity sets out there. Now, at the moment, when you look at crypto assets, they're very different from gold. They haven't been around for decades freely trading, and thousands of years in one form or another in the case of gold. And they're obviously in a new growth phase, which seems to be favoring adoption and price increase. So I can completely understand why the hedge fund community and some of the fabled investors that you've mentioned have entered into these crypto assets. But again, just because they said 6 months ago that they were long, they may not necessarily be now, because they do move their portfolios around very quickly. So again, I think I'm not here to damn or praise crypto assets, but I can certainly see why at certain times they've been very attractive to speculative investors, particularly those that could be in and out of the markets quickly.
In your position at the World Gold Council, have you received a lot of interest in gold in the past year, or is there a real sense of complacency within the sector?
Yeah, it's interesting. I mean, look, we always get inquiries about gold because we're known for what we do, and if anybody has any interest in gold, they typically end up coming to speak to us. So it's never dead quiet, but sometimes it is busier than others. So I'd say the second and third quarter of 2020 when we were at the depths of the pandemic recession and gold prices were moving higher towards all-time highs, of course, it was very busy then. But it's remained busy ever since. And one of the things that is, in many respects, easier to make the case for why gold should be a strategic part of your portfolio, it's easy to do that when gold's not at its all-time highs. You know, even I start to get a little bit concerned about recommending that investors hold gold when it's just, you know, just hit the highest price it ever has done. So we're continuing to have lots of conversations with institutional investors about why gold should form a permanent part of their portfolio. And we're having wins. Again, can't detail them for obvious reasons, but through the back end of last year and even at the start of 2022, we've had some big wins where investors have agreed with us and either have deployed or are deploying investments into gold.
And maybe you can just expand on that. Why should an investor, regardless if you're an institutional investor or retail investor, have exposure to gold in their portfolio?
Well, the simplest reason for the strategic case for gold comes down to basically three arguments. One of which is it's been a source of returns over the long term. So if you look since 1971, since we came off the gold standard, or if you look over the last 20 years, gold's produced returns which have been in line with or better than other asset classes like equities, bonds, cash, etc. So it's not just there for crises. It's not just there for periods of very high inflation, like at the end of the 70s and the early 80s. It's actually been a contributor of returns to your portfolio over the long term. The second thing, though, is that it is a great diversifier. And this comes back to what I was saying before. Generally speaking, gold's uncorrelated to equities. But when equity markets are falling fast, gold tends to go up. That correlation between gold and equity strengthens in a negative way. So you're now negatively correlated to something that's falling quickly. That's a really positive aspect or attribute of an asset class, and something that's not matched by anything else. We've looked at all the other asset classes out there, and nothing else experiences this change in correlation favorably when equity markets are so weak. So that combination of returns and diversification that works when you really want it, has a portfolio impact, whereby having gold in your portfolio, and it depends on your portfolio, but 5 to 10% is typically the range that it works out as. Adding 5 to 10% of your portfolio to gold increases your risk-adjusted return. So those are really the reasons. In simple, a source of returns, a diversifier, and it contributes positively to pretty much every portfolio we've looked at, not just in the US, but Canada, Australia, the UK, Euro time zones, Russia, etc. We've looked at this work in a lot of detail all around the world.
John, as we wrap up, I'm going to put you on the spot now. Where's the gold price going in 2022, and when can we firmly see it through the $2,000 level?
Yeah, for complicated reasons to do with our ownership structure, we don't give explicit forecasts. But what I can say is, if I look historically, gold's tended to underperform in the 6 months before the Fed starts to hike. And it looks fairly clear, based on all of the statements from Federal Reserve officials, that we're going to start to see interest rate hikes very soon, almost certainly in March. Now, historically, the period after the Fed started to hike has generally been a better one for gold than immediately before. So I'm thinking that once we are no longer guessing whether the Fed will hike or not, and actually recognizing that it is in a hiking cycle, I suspect gold will perform better. What probably is required, though, to take gold up to new all-time highs above $2,000 an ounce is a reaction from the real economy and potentially from markets first, that the ability of the global economy and the US economy in particular to tolerate materially higher interest rates is limited. So if we get to a situation a bit like we saw in 2017, 2018, where the Fed started hiking and then had to stop and reverse, and particularly if that takes place when inflation is still elevated, then that could be a time that gold and other precious metals start to benefit materially. So timing, difficult to know. Certainly, I think the Fed starts hiking in the next couple of months. When will the economy show that it can't really tolerate much higher interest rates? That might take a year or so after that.
John, that's a great discussion on gold, and I want to thank you for spending time with us today. To all of our viewers, I would encourage you to check out the World Gold Council website. It has a wealth of information on there, everything to do with gold. Once again, John, thank you.
Thank you, Jimmy.
Hi, Sandip. Thank you very much for joining us today. How are things in Toronto?
Things are good. Thanks for having us, Jimmy.
Sandip, Franco-Nevada was the first ever royalty company, having been established in 1982, so it has a very rich history in the royalty sector. And before we jump into your various assets and operations, why don't we just start with a brief history of Franco, because it really speaks to the optionality associated with this sector.
Sure. I could go on for a while, but I'll give you a quick snapshot. Company, as you said, started in 1982. Two gentlemen, Seymour Schulich, Pierre Lassonde. Seymour was the oil and gas investor. Pierre was the mining guy. They started, a mining company with the intention of being like any other mining company. Go out, stake some land, drill it, hopefully find a deposit, build a mine. But along the way, Seymour said to Pierre, on the energy side, there's lots of royalties on properties. Is that common in the mining business? And Pierre said, for sure, Seymour. And so in 1986, they spent all the money they had, which was about $2 million. And they bought a royalty on a small little property owned by a third party. The property was called Gold Strike, had about 500,000 ounces of resources on it. So as I said, they spent the $2 million. A few years later, American Barrick, which is now Barrick Gold, went in and bought that property. I think they paid about $75 million for it at the time. Turned it, did some deep drilling and turned that 500,000 ounces into over 50 million. So that $2 million investment to Franco has paid almost $1 billion, and the mine's got another 10 plus years to go. So that is really, as you said, true power of optionality and a perfect case. And from that point onward, Franco-Nevada just became a royalty company, and then, as you can say, the rest is history.
So that one asset was a company maker, not just for Franco, but also for Barrick.
Oh, absolutely. For us, from Franco, it evolved into becoming just a royalty company and accumulating royalties over time. And for Barrick, where their share price went after that allowed them to do acquisitions subsequently. So absolutely, company maker for both companies.
So that's I love that story. Now let's move on to your assets, just to provide a brief overview of Franco-Nevada and the breakdown between the mining side of the business and also energy.
Sure. So Franco is the largest royalty streaming company by market cap and by number of assets. We've got over 400 assets, 112 producing, split between mining and energy. And then we've got over 200 exploration assets. For us, we think of diversification as our strength. So obviously we're a precious metals royalty streaming company, but we think that diversification reduces risk in the portfolio. So for us, we will always do precious metal deals, but we've typically done energy as that diversification, but we have copper, we've got nickel. And then last year we did a royalty on Vale's Brazilian assets for iron ore, which we consider the best iron ore assets in the world. So, being able to do that additional non-precious metal commodity adds diversification, and as I said, reduces risk. So for us, as I said, we've got the largest portfolio, most diverse, and we think it's one of the strengths of Franco.
So your single largest asset on the mining side is First Quantum's Cobre Panama mine, which is a large copper mine in Panama. It continues to ramp, providing significant cash flow for both Franco-Nevada and also First Quantum. Why don't we just start with an overview of this asset and an update on what's going on the mining side?
Sure. So Cobre Panama, as you said, First Quantum, they built it and they've ramped it up and have done a great job on both fronts. It's one of the largest copper mines in the world. Right now it's doing 85 million tons per year. First Quantum has announced another expansion to 100 million tons per year. So that's underway now. So we'll start benefiting from that in 2023. So what Franco has, we have a precious metal stream here. So for every pound of copper that gets produced, Franco receives a certain amount of gold and silver, and that is for the life of the mine. And so for us, it's our largest asset, it's our largest revenue generator, but even then, it's less than 20% of our revenue. And First Quantum, just recently, I think they released the results last week, and they've upped their guidance for 2022, 2023 in terms of their copper production guidance, which will be a bonus for Franco for the next couple of years. And as I mentioned, after that, the expansion kicks in. And to be honest, me personally, I believe there'll be further expansions at this mine. It's world class. It's pretty simple mining, and it's a very large land package, which we think has huge exploration potential.
And one of the great things about these large copper mines or base metal mines is their mine life. A gold mine might have 8 to 10 years, whereas these large copper mines, it could be 20, 30, 40 years. What's the mine life on Cobre Panama?
So reserves is about 30 plus years right now, but when you factor in resources, we think this mine will be in operation for 50 plus years. We think it'll be the longest life mine within our portfolio, that and Antamina. Antamina is another copper asset in Peru. It's operated by a consortium of BHP, Glencore, Teck, and I believe it's Mitsubishi. We have a silver stream here on Teck's 22.5% interest. And again, it's one of the lowest cost copper assets in the world. Right now, the limitation is tailings capacity, but once they get new tailings capacity permitted, the resource is basically the same grade as the reserve. So again, we expect this mine to be in operation for 50 plus years as well. So it gives a nice strong foundation of cash flow to Franco.
And Sandip, I just want to ask one more question on Cobre Panama. When did you initially make that investment, and when did it start cash flowing?
So we did the initial deal in 2012, and we did it with a company called Inmet Mining. They had a $6 billion capital cost to build the mine. And so we were putting in $1 billion at the time, and they were raising money through high yield debt and other sources to fund the construction. Before construction started, First Quantum acquired Inmet and then rechanged the engineering plan on mine development. So the mine started construction a few years later than it was initially intended, but our money didn't go in until it started construction. So it wasn't as if we'd put in the $1 billion right away. At the end of the day, we ended up putting in 1.35 billion. And the mine, our first cash flow was in 2019 when the mine started.
So from your perspective, you really have to be patient when you enter into these agreements.
Oh, absolutely. And that is, I think, one of our strengths is because we have such a large portfolio and a diverse portfolio, we can be patient. Jimmy, I'll tell you, there's deals that we've done. So I'll give you an example. Hudbay has a property in Arizona, which they're trying to get permitted, called Rosemont. We bought that royalty in 1989 for less than $1 million. So, you're going on 30 plus years now, and the mine is not built, but they've got a new discovery called Copper World. If that gets permitted and built, that $1 million investment will be paying us 20 million plus a year in revenue and for the life of the mine. And so, yes, it's taken a long time, but patience is what you have to do. And by having a larger portfolio, it gives you the ability to be patient.
Wow, that's a great story. So another significant asset in your portfolio is Lundin's Candelaria mine, which is another large copper mine in Chile. Why don't you just provide an overview of this asset and also tell us what's happening on the production side?
Sure. So we helped Lundin buy Candelaria. If you recall, 2014, we had a bit of a base metal pullback. Copper went back to $2 a pound. And so you had a lot of the mining guys had leveraged up their balance sheets and needed some assistance in helping reduce those debt levels. Freeport, which was the owner of Candelaria, decided to sell the mine. We assisted Lundin in acquiring it. I believe they paid 1.8 billion, and we did a stream and a little bit of equity for 655 million. At the time, the mine had 14 years of reserves. Lundine's done an unbelievable job on the exploration front, and today the mine life is 25 plus years. And considering that it's already mined at 7 years from when we acquired it, so that 14 years has turned into over 30 years. Again, it's the power of optionality and our business model. So as I said, the mine life is longer. Lundine's done a very good job on the exploration front. It has had some challenges the last couple of years on the operational side, but we believe that's behind them. They have given out their guidance for 2022. It's a little lighter than it was in 2021. But as they improve the operations and the high grade underground comes into play, we expect higher production from Candelaria, 2023 onward.
Sandip, as you mentioned, 80% of your portfolio is focused on precious metals and 20% is focused on other resources. Energy is making up a large component of that other 20. So I want to spend some time here. And the oil price is over $90 a barrel now, the highest it's been since 2014, and as a result your energy revenues are significantly higher year over year. But before we examine your energy assets, why don't you tell us why you ventured into energy?
So as I said at the outset, Seymour Schulich was an oil and gas investor, and we like the ability to sort of hedge the precious metals. Those two commodities sort of tend to trade opposite to each other. So in the early 90s, we ventured into Western Canada and bought royalties out there. And those oil and gas royalties are still paying today, decades later. So really, even though it's a different commodity, the whole business model and the premise of optionality and commodity optionality is still there, whether it's energy or the mining side. So we've always done that in Western Canada. But when oil dropped in 2016 to about $30 a barrel, we finally ventured into the United States, and we looked in the US and we said, which are the basins that will survive if oil demand falls or if prices fall? So basically the lowest cost basins, and that was the Stack Scoop in Oklahoma and the Permian down in Texas. And so we bought royalty packages down there, and at the time, I guess the average price that we paid was $55 a barrel. Obviously in 2020 there was the big dip in energy prices because of the pandemic. But as you said, we're back over $90 a barrel. It's a volatile commodity. We appreciate that, but we think we've invested in good assets, and we think they'll contribute for the next few decades.
And I'm sorry, what's the breakdown between mining and energy revenues?
So right now, energy is less than 20%. And, it's fluctuated over time. It's been less than 10, up to 20%. It's about 17% last quarter. Obviously, you don't know what the commodity prices are going to do. But as we continue to grow Franco Nevada, I think energy will become less significant within the portfolio.
So your most recent acquisition on the energy side was the Haynesville natural gas asset. Why don't you just provide a brief overview of this?
Sure, yes. So we bought that in early part of 2021. It's a royalty package in the Haynesville. The main operator there is Rockcliff. At the time, natural gas was $2.50, I believe, and obviously we've been over $4 for some time now. So it was a very good deal. The last two deals we've actually done in the energy space have been natural gas transactions. We think natural gas has a longer life than fossil fuels. Kind of look at it as a transition fossil fuel. So for us, we did a $300 million deal in the Marcellus with Range Resources, and then obviously the Haynesville, as you mentioned. So I would say we're tending towards the natural gas side of the business versus the oil side. But those assets have performed very, very well, and the payback on Haynesville is going to be half of what we expected based on current commodity prices.
And given the success and the growth within your energy business, would you ever consider a spin out of these assets into a separate company?
It's a good question. We have looked at it a few times. Obviously, whenever oil spikes, we do take a look at it. Two things with it. Number one is just energy within Franco trades at a very different multiple than a standalone energy royalty company. Because if you go out there and you look at the Vipers of the world and the Prairie Skies, they do trade at lower multiples. So it's not exactly value accretive to Franco shareholders. That said, it's not something that we are opposed to. As I said, we've looked at it. But right now, we think the energy portfolio adds some balance to Franco's portfolio. And we don't intend to grow it at this time, so it should diminish over time. And we think it just provides diversification, and with that comes, reduces risk. So we think the best place for the energy assets is within the Franco portfolio at this time.
That's a great overview of your mining and energy assets, Sandip. Why don't we move on? I want to look at your balance sheet now and just tell us how much cash do you have on the balance sheet and how much liquidity do you have available to pursue new agreements?
Sure. So we've got roughly $500 million in cash and investments on the balance sheet. When you add in the credit facilities, we've got about 1.4, 1.5 billion. Obviously, we have more than that. We could increase our credit facility easily, but the reality is we never intend to draw upon it because we don't believe in leverage of that size. So we've got ample firepower to go out and do further deals. And that's what, we're out there looking at the market, but we're only going to do good deals.
And Sandip, you've been relatively quiet on the deal front in the past year, and you also increased your dividend just recently. Does this mean there are a few quality deals that meet your standards?
The deal pipeline is actually quite active. At the end of the day, we have a process we go through. From a technical standpoint, we have a technical committee from the board, which we have to go through on our deals. And we have our criteria. And if it doesn't meet our criteria, then obviously we don't move forward. That comes into play with valuation. Our fundamental policy or philosophy is we will only do good deals on good assets. That's not to say that the assets out there, the deals out there are not good assets. It's just that, maybe we had a different view on optionality on the upside, or maybe we weren't as aggressive on the pricing. But we've looked at a lot of things. We haven't been able to complete them, but the pipeline definitely is active.
And if you can't find deals that meet your standards, does this mean we can expect higher dividends in the future?
It's a balance. Our number one goal for the company is to grow the company, and we believe we can. So we want to deploy our capital to add assets to the portfolio. If you look at the last 10 years, we've done anywhere between 600 and 700 million a year in deals. Obviously, some years more, some years less. Even if you look at 2021, we did over 850 million in deals. So that is the priority for us of where capital will be deployed. But second to that is obviously returning to shareholders. We've paid about 1.7 billion in dividends since our IPO. We've raised the dividend every single year. And in fact, just 2 weeks ago, we announced our dividend increase for 2022, 7% to 32 cents US per share per quarter. As I said, that's 15 years of increases. Our philosophy on the dividend is progressive and sustainable. So, if you look at the gold price, it was $750 at IPO. It went all the way up to $1,900, back to $1,050, and now we're back to $1,800. During that volatile movement, we raised our dividend every single year. And that is our objective, is to raise it every year, regardless of what's happening with commodity prices. We do get asked the question, would we tie it to some sort of formula? And the answer is no, because if commodity prices are retreating, the likelihood is that your share price is retreating as well. So you don't want your dividend cut at the same time. We want to do the opposite. If the share price isn't performing as well, at least you're getting a higher dividend. And so that is sort of our philosophy. So we do intend to continue to increase the dividend, as I said, progressive and sustainable.
So that's a great overview of your assets and your balance sheet. And I want to move on and just ask you a few general questions about the royalty and streaming business as a whole. And I want to start with how the royalty and streaming business has evolved over the past decade.
It's come a long way. Like when I rejoined Franco in 2010, streaming was sort of or royalty and streaming financing was sort of a financing of last resort. Companies would look at debt, equity, equipment refi, all those other avenues of raising money, and royalty streaming was last on the list. if you look at it today, if you're a CFO of a small junior company or a CFO of a large major, and you're looking at raising funds, you're looking at streaming or royalty financing. It is common, and I don't think you can walk into a boardroom and have a discussion with your board on financing without royalty streaming being at least one of the items on the list. Whether you go through with the process or not is a different question, but it's become accepted. It's proven. You've got companies like Barrick and Glencore and Teck that have done it, and even larger companies than that have looked at it. So from our perspective, it's come a long way. It's widely accepted, and you just look at the number of companies in the royalty streaming space now. Every month, I think there's a new small junior royalty company coming out, which tells you that people have accepted the model.
I want to move on now and discuss jurisdiction. A large percentage of your assets are based in the Americas, and given the size of your business today and also the diversification of the revenue stream, would Franco-Nevada consider moving into a more riskier jurisdiction? And I'm thinking about West Africa or maybe parts of Asia.
We would. Firstly, it all starts with the deposit. What is the asset like? What's the upside there? Does it meet our technical criteria? And then from that point, you look at jurisdiction, you look at structure, how do you protect yourselves? But we have such a large, diverse portfolio that, adding an asset in a potentially more riskier jurisdiction can fit within the portfolio because you're not betting the company on it. And the reality is it comes down to what's the dollar size that you'd be willing to invest in one of these jurisdictions. Putting 5% of your NAV or roughly $500 million into one of these jurisdictions is a risk I think we can afford to take. Again, just because we are so diverse and we have, the majority of our assets in proven jurisdictions, mining-friendly jurisdictions, so we can accommodate that risk. But again, it just comes down to what's the quality of the asset.
We already discussed the success of the Gold Strike royalty and how profitable that's been for Franco-Nevada. Are there any other assets that have been as profitable or nearly as profitable?
Yeah, I think, by having such a large portfolio and looking at the history, every year, every couple of years, you get these surprises, right? If you just look at our IPO portfolio, you had Detour, which was a shutdown mine, and restarted, rebuilt, restarted, and now it's up to 30 million ounces. Tasiast, same thing, small little mine. Now it's Kinross's largest asset. Duketon in Australia with Regis Resources. So every few years you get these assets that just pop out of the woodwork, or positive news it comes out and you benefit from that. And the beauty of that, it's all organic growth. So the cost to Franco is zero. And even if you look at it today, as I mentioned, Cobre Panama is doing an expansion. Stillwater is doing an expansion. Detour is expanding. Tasiast, Subika, I can go on. The list is extensive. So again, that's all organic growth. And then those royalties that we've bought over the last number of years, those mines on those undeveloped are now getting built. Gold Fields is building Solaris Norte in Chile. The JV partners Orion and Equinox at Greenstone have announced they're moving forward with that construction. Seguela with Fortuna is under construction. We expect Valentine Lake with Marathon to be built. So all that organic growth over time, you just have to be patient, and it's all cost-free to Franco. And I think there's a slide in our deck which is just ideal. It shows our IPO assets and how they've grown over time. So at our IPO, we had about 30 million ounces of gold reserves on those assets. Fast forward to the end of 2020, those same assets have 70 million ounces of reserves on them. Meanwhile, 40 million has been mined. So that 30 million turned into 110 million, and in between, 1.6 billion in revenue was paid to Franco-Nevada. So those assets have 3 times as much on them than when they were at IPO. All of that with no cost to Franco. So I love that slide. It's in our deck, and it basically, in one slide, showcases the true optionality within the Franco model.
Is there one asset on the exploration side or the development side that you think holds a lot of promise?
There's a number, but the one I will reference is the Ring of Fire. So this is an underexplored area in Northern Ontario. About a decade ago, Cliffs Resources went in and bought and accumulated a large land package there. It has the highest grade chromite deposit outside of South Africa. We know it's got nickel, copper, platinum, palladium, gold, silver. All the metals are up there in some form. There's been some drilling, but there's no infrastructure to get there. In 2014, 2015, Cliffs ran into trouble and decided to sell it. After putting in about $1 billion, they sold it for 25 million to Noront Resources. We loaned Noront the money to buy the asset. So that loan will get repaid to us. At the same time, we wrote a bunch of royalties, anywhere from 1% to 3% on the land package. And so recently, Noront has been taken over. There was a bidding war between BHP and Wyloo, and it looks like Wyloo Metals, which is run by Andrew Fortescue, looks like they're the winning bidder. And so, we think that obviously there's a highway that's needed to allow access into that area, which the provincial government will fund. It's about $1 billion cost. But if you're the provincial government, you want to know that on the other end of it, you've got a deep-pocketed miner who has the capacity to build mines and do exploration. So Wyloo is that party. So, we're actually quite excited. This isn't something that's going to come into play in the next 5 years, but this is something that, in a decade, maybe a bit more, we think could be an unbelievable win for Franco and likely for the next management team. But it goes to our long-term thinking, that we're not just thinking about this year or next year, we're actually thinking for the next 10 years, 20 years on how to continue to grow this company. So we're actually quite excited with the Ring of Fire.
That's another great story. Thank you for sharing it. Sandip, as we wrap up, Franco trades at the highest multiple of your peer group. Depending on whose research you look at, it could be anywhere from 2 times to 2.5 times price to NAV. Why is Franco trading at such a rich premium?
Good question. And, investors ask us that all the time. I think it's a number of factors. One is our track record. We created the royalty model back in the 80s, been doing it for 35 plus years. And I think over that time frame, we've shown that we are good allocators of capital. And so part of that is also the technical skill set, not of just management, but the board. I think we have one of the best boards in the mining business. And so I think that track record, is part of the reason why we trade where we do. Secondly is the portfolio itself. As I said, it's the largest and most diverse, whether it be by asset, commodity, geography, operator. And so with that comes lower risk. So we think Franco is the lowest risk way to invest in gold and precious metals. And then I think finally it's just the owner mentality. Management and the board own over $200 million worth of stock in Franco. That's multiples of what our peers own. And so that impacts us 2 ways. One is how we run the company in terms of spending money and our G&A. If you look at our G&A, it's been pretty well consistent for the last 10 plus years. And that's because we treat our cash as if it's shareholder cash. And secondly, in doing deals and allocating capital, again, because we're owners in the company, we're only going to do deals on good assets. And we're not going to chase deals and do deals just to grow the company. So I think when you look at all of that, you look at the track record, you look at the diverse portfolio, you look at the owner mentality, those things combined, I think lend to where we, our valuation and justifies our valuation. And it goes to our tagline. We think Franco-Nevada truly is the gold investment that works.
And one more question before I let you go, but because Franco is trading at a rich premium of 2 times price to NAV, would you ever consider buying another royalty company that's trading at 1 times?
We've done M&A before. 2 things on M&A. One is just due diligence. Do you get the ability to do due diligence? And then in a lot of cases, the contracts, obviously you haven't written them yourself, so it might not have the protections that you do. If a royalty company or streaming company was trading at 1 times NAV, it would make sense for us to look at it. But we'd have to question why it's trading at 1 times NAV, as most royalty streaming companies trade above that. We still think the best way and the real way to create shareholder value is to do deals ourselves, where we have the ability to do technical due diligence and write our own contracts, and buy assets at 1 times NAV. So that is the priority. But if a mining company was trading at 1x NAV, it would obviously make sense for us to take a look. But we do our due diligence.
Sandip, that's a great update and overview of Franco-Nevada, and I want to thank you for spending time with us today. And to all of the viewers, if you have any further questions for the Franco-Nevada management team, please send us an email to info@bloorstreetcapital.com. Sandip, once again, thank you.
Thanks very much, Jimmy. Appreciate it.
Hi, Matt. Thank you very much for joining us today. How are things in Vancouver?
Hi, Jimmy. Things are going great. Thank you. First of all, on behalf of Maverix, we just want to thank you for having us today at the Bloor Street Royalty Conference.
Oh, you're welcome. Thank you. Matt, Maverix finished up with a strong 2021, exceeding the high end of your guidance of 30,000 GEOs. You came in with 31,000 GEOs. And before we look at the various assets that resulted in that higher production, why don't we first start with a brief overview of Maverix Metals for those investors who might not be familiar with the company?
Yeah, no, absolutely. And just a small nuance there. Our guidance for 2021 was increased from 27 to 30,000 ounces to approximately 31,000 ounces. And we hope to release our GEOs our 2021 GEOs in the coming weeks here. But yeah, so Maverix is a precious metal focused royalty company that was launched in July of 2016. There was a portfolio spin out, sorry, of Maverix from Pan American Silver that really started the company going. Since then, we've accumulated 122 different royalties and stream, 14 of which are paying, and our market capitalization sits around $650 million at this time.
And Matt, what percent of your revenues come from gold and what percent comes from silver?
Yeah, so we're at 99% revenue from gold and silver on an aggregate basis. If you're to break that down, we're at about 76% from gold and 26% from silver.
Matt, another unique feature of the Maverix story is your shareholder base. You have 3 corporates as shareholders: Newmont, Pan American, and also Kinross. Why don't we first start by telling us how you gained those corporates as shareholders?
Yeah, no, absolutely. I think it's a very telling feature of Maverix and its ability to work with its shareholders. So, Newmont originally came on the registry. They're at 29% now, but we did 2 portfolio acquisitions, one in 2018 and another one in 2020. And then Pan American Silver, we've already talked about the inaugural spin-out of their royalty portfolio. We also did a second portfolio acquisition with them in 2021 here, and they're sitting at about 18%.
And Matt, given that both Newmont and Pan American are sitting on your board of directors, does that mean you get to see all the royalties and streams from those companies on a first-come basis?
Yeah, I mean, we definitely have some contractual arrangements under their shareholders agreements with us. There's other, I would say, ancillary benefits to having them, both on, I guess, having board representative on Maverix, but also just in terms of opportunities that they're able to pass our way. And, having those names on our shareholder registry is a real endorsement to our management team and board. They've entrusted us with their portfolio of royalties and to create value for them and their shareholders. The other thing too is each of those organizations have very strong technical bench strength that we can tap into if needed. Oftentimes they've looked at projects that we're looking at and can provide a secondary review or advice to us as well. And then a few other points that I'll note is it is, and just more sets of eyes and ears out there that's connected to information flow that we may not be connected to, being a royalty and streaming company. If they see an opportunity that might be a fit, it's pretty easy for them to refer it along to us. And then the other point that I'll make, and you can see it with both Pan American and Newmont, is those companies are continually creating new royalties. And that's evidenced by, we've done 2 portfolio acquisitions with both Nomad and Pan American Silver.
That's great. That's a great overview of Maverix Metals. Now I want to move on and I want to look at your portfolio of assets, beginning with your largest one, and your largest asset on a NAV basis is the Beta Hunt Gold Nickel Mine, which is located in Australia, and it's owned by Karora Resources. They announced last year that they want to double production from 100,000 ounces to 200,000 ounces. Why don't you provide an overview of this asset and also an update on how that mine expansion is going?
Yeah, no, exciting. This is one that's been exciting to watch. And just for your your viewers' knowledge, we have a 4.75% gold royalty interest there and a 1.5% nickel royalty interest, which we purchased back in 2016 and 2017. And so your viewers may recall, and this is going back to 2018, I believe, that Karora discovered the Father's Day vein, which is where Karora pulled out some very impressive specimen stones that made international headlines at the time, and was really a turning point for the company. Since then they've gone on to release a maiden reserve back in 2019, I believe, and then they've also continually released exciting exploration results. Most recently on the Fletcher zone, where they've increased the strike length to 500 meters with a potential to increase it up to 2 kilometers. They are expected to put out a new reserve and resource statement out in the first quarter here, and then with all the resources they're finding, they've also announced a series of mill expansions as well that we're really excited about. The phase 1 expansion, just to give you some numbers, was 1.4 million tons to 1.6 million tons per annum, and then in June of 2021 they announced a phase 2 expansion of the Higginsville mill down in Western Australia and they're going to increase the capacity to 2.5 million tons by 2024 is the idea. And so some of your viewers may be wondering, well, where's all the feed going to come from? We were pretty happy to see that they also released that they're going to expand the Beta Hunt underground mine there up to about 2 million tons per annum by a second decline that they're I think they've started building now. And just for context and to paint some numbers around it, in 2020, Beta Hunt did about 800,000 tons. So you're seeing about a 2.5 times increase in production there. So very, very excited for Maverix and the shareholders on that asset.
Another asset of significance is Pan American's La Colorado mine. Provide an overview of this operation. They're going through an optimization program that's resulted in higher production. Why don't you tell us about this asset and also how that program is going?
Yeah, so La Colorado is one of our cornerstone assets. We acquired the gold stream there in 2016 as part of that initial spin out that we were talking about earlier. We have a 100% gold stream and we pay $650 per ounce. They've done a good job, I would say, with the optimization program. They did have a few what we'll call hiccups earlier in 2021 with the ventilation blockage and then some shipping delays, which was effectively a global issue, we'll say. That we understand that both have been fixed and they're seeing continued improvement there. From a Maverix perspective, we look at some of these things and really we just see any of the issues that I just discussed, or hiccups, I guess is the way I described it, as a timing difference of receipt of gold, not a permanent shift or difference there. And so Pan American Silver is a great operating company and they continue to do great work.
Another asset I want to ask you about is Agnico's Hope Bay mine, which was acquired through the acquisition of TMAC. Give us some details on this.
Yeah, so that's been another interesting to watch. And so we originally acquired a 1% royalty on the Hope Bay mine as part of the first Newmont portfolio acquisition in 2018. And then we completed a second royalty acquisition for $40 million where we acquired an additional 1.5% royalty. That additional 1.5% royalty included a buyback right upon a change of control where Agnico exercised it and had to deliver $50 million back to Maverix. So we put 40 million in, we got 50 million back. And then the other thing that we highlight to shareholders and potential shareholders is that we were able to keep the intervening royalty revenue that we earned on that 1.5% royalty, which amounted to just over 4.5 million US as well. So you add that all up, call it a $14.5 million return on 40 million. We were pretty happy with that. So after that buyback, we do retain our 1% interest at Hope Bay. There are no further buyback rights or anything like that associated with that interest. And Agnico Eagle, when they came and acquired the asset or closed on it in early 2021, they announced a 70,000 meter drill program. They've had some exciting exploration results come out of there in the back half of 2021. And Agnico's said that Hope Bay has the potential to be a 250 to 300,000 ounce gold per year operation. So we're excited about the news flow coming out of that asset as well.
And I guess, Matt, the fact that they did exercise that buyback for $50 million probably speaks to what they think could be there.
Yeah, absolutely. It's got a solid resource base up there, and you know, we're excited to see what they do with the asset. They obviously have a very strong balance sheet, very strong technical bench strength there, and experience operating up north. So you know, that's a story that we follow closely here at Maverix.
And remind me again, is TMAC or Hope Bay currently producing?
So they were producing. Unfortunately, they did have a COVID outbreak at the end of 2021 there, and so they've shut the mine down temporarily to deal with that. And then we are awaiting news out of the Agnico camp on any future considerations with the operation there.
Matt, you've also had some other assets that have had some news recently, and I want to touch on those, beginning with Camino Rojo. They had a first gold pour in late December, and they're moving toward commercial production. Tell us about this asset and also give us an update on how they are making out.
Yeah, no, I think you know, first and foremost, we need to congratulate the management team over at Orla. I mean, they built that mine on schedule and on budget. Through a health pandemic to boot, and so you know, at least from my perspective, that's nothing short of impressive. And so as you noted, they press released their first gold pour back in December, and then they've said publicly that they're targeting commercial production sometime in the first quarter of 2022 here. So you know, we're quite excited about that, and you know, this is, I would say, a great example of a development stage royalty interest where the asset has been built and is being put into production, and it will be generating cash flow for Maverix and its shareholders in 2022 here.
Matt, late in 2021, Maverix entered into a gold stream with Awram, and this is not a traditional royalty agreement in that Awram's not a mining company. But why don't you provide us with a little bit of background on Awram and tell us about this agreement?
Yeah, no, happy to. So Awram is one of the largest physical precious metal merchants in the world. They had over 20 billion in revenues last year, and their predominant lines of business are physical metals trading, which is the single largest line of business they do. They also do some merchant banking and advisory services as well. And we entered into a fixed gold stream with them where they'll deliver 1,250 ounces to us a quarter, or 5,000 ounces a year. And in return for that gold, we'll pay 16% of spot price. The other, I would say, unique feature of that deal is included in the agreement. We put a right of first refusal, and so to the extent that Awram decides that they want to sell any royalties or streams in their current portfolio or any future acquisitions that they make, we'll get first right of refusal on that. And then the other term that we baked in there was we have a right to participate in any royalty or stream transactions that Awram contemplates where the transaction is greater than $20 million. And so just to highlight why we think that's, you know, those are important terms to put in the agreement. We touched on Beta Hunt here briefly previously, and a portion of the Beta Hunt royalty interest that we acquired was actually from Awram back in 2017. So there is some real value to harvest there.
And Matt, I'm curious about why you entered into this deal, because it is a non-traditional royalty agreement. But does this have to do with the level of, or the higher level of competition that you now find within the royalty and streaming space? Has it forced you and your team to find other creative ways to generate value for shareholders?
Yeah, I think I'll answer that question in two parts. One, you know, I think on a standalone basis, we like the Awram deal. It is a little bit non-traditional, but We think it provides great immediate cash flow to our shareholders and exposure to gold over a good term here. So we're excited about that. But you know, the second part of your commentary there on competition, I mean, I don't think it's any secret there that there were a lot of new entrants that came into the royalty and streaming space over the past year or so, and you know, we view that as a real testament to the strength of the business model. The royalty and streaming business model is one that we're very excited to be in. The other, you know, few points I'll make is there were certainly more competitors that came into the space, but we also saw a lot more opportunities as well. So you kind of leveled the playing field a bit there. And then, you know, from a Maverix perspective, yeah, I think we were able to operate in the niches that we've developed for ourselves. And so what we've tried to do is maintain the internal rates of return that we like to see on deals. And if you look at the last 4 deals that we've completed, they've all been done with existing relationships that we've had.
Matt, let's move on to your balance sheet now. How much cash do you have and how much liquidity do you have to deploy toward new agreements?
Yeah, so we currently have about $20 million in cash and marketable securities. And then we also have a $160 million revolving credit facility, of which $13 million is drawn. So that adds up to about $167 million that we can deploy into new royalty and stream opportunities.
And Matt, before we wrap it up, maybe you want to give us some color on the pipeline. How is it looking? Are there a lot of deals out there?
Yeah, you know what? It's I'd say 2021 was probably one of the busiest years we had on the corporate development front, and that is filtered into or trickled into 2022 here. We're hard at work, and there's seemingly a lot of opportunities out there, and we look forward to hopefully closing something or a few different deals in 2022 here.
How many deals do you think you and your team looked at in 2021?
It's a number that probably doesn't make sense to a lot of people. It is amazing how much work goes in behind the scenes versus how many deals that we close and publicly announce. But you know, that's the fun of it, and we're up for the challenge.
Matt, as we wrap up, what can investors in Maverix Metals expect in terms of news flow in the coming months?
Yeah, no, I think so. I mean, I think just on the you know, the financial reporting side of the business, which is near and dear to my heart as the CFO. You know, I will point out in 2022, we should see full year contributions of deals that we closed in 2021. So the Awram and Nomad deals that we just talked about, and then Camino Rojo will have, you know, a meaningful contribution to revenue next year as well. And then on the development side of the portfolio, so the underlying operators, you know, there's quite a bit of news flow expected in the first quarter here, being DLMR is going to have a pre-feasibility study out. Coney is expected to release a Coney feasibility study, which is expected in the first quarter as well. We have the South Railroad feasibility study, the Beta Hunt resource update that we've already talked about, and then a feasibility study on an asset called Cerro Blanco, which is expected in the first half of the year as well. Then on the corporate side, I think, you know, we touched on it earlier in the interview, but we're just waiting on a few results from our royalty partners. Once we have those, we'll be in a position to announce our 2021 gold equivalent ounces for the year. So we'll hopefully get that out in the next few weeks here. Probably towards the end of February, we will be releasing our outlook for 2022. Again, this is dependent on receiving some mine plans from a few of our operators, so we will be sharing that with the marketplace. And then again, near and dear to my heart, we'll have our annual financial results out in mid-March here.
Well, that's a great overview and a great update on Maverix Metals, and I want to thank you, Matt, for spending time with us today. And to all of our viewers, if you have any further questions for Matt and his team, by all means, send us an email to info@bloorstreetcapital.com. Once again, Matt, thank you.
Thank you for having me today. Appreciate it very much.
Hi, Joe. Thank you very much for joining us today. How are things in Montreal?
Very good. Thanks for having me, Jimmy.
Joe, since you presented at our last royalty conference in 2021, Nomad, royalty has undergone a significant transformation by acquiring new assets, including Greenstone and Plant Reef. But before we dive into these new assets, why don't you just start with a brief overview of Nomad?
Sure, absolutely. So Nomad, we are a precious metals royalty and streaming company. We would be considered as a mid-tier precious metal royalty and streaming company with a market cap of about $500 million Canadian today. We have a portfolio made up of 22 assets, 8 of which are currently producing. And we consider ourselves to be a pure play royalty and streaming company. So what that means is, we have royalties and streams only, no direct participations in assets or anything that's off the beaten path for this type of business, which allows us to generate, the really high margins that you typically see with Nomad being at about 90% cash margin. We started the company in 2020. We've been listed for just under 2 years, listed on the TSX, but also recently on the New York Stock Exchange. And in that period of time, we've done a lot with the platform that we have and have been able to deploy a significant amount of capital into new acquisitions to grow our portfolio with about $225 million of deals done just last year alone. So it's a very exciting part or a very exciting time for Nomad within our evolution, a really good time to be looking at the story again if you looked at it in the past, because of the acquisitions we've done, it's a different portrait now, and we've significantly enhanced the quality of the portfolio, quality of the counterparties where we have royalties and streams. We're continuing to pay one of the highest dividend yields in the sector, a 2.5% dividend yield, and it's really what makes our company stand out within the overall peer group. We started the company with a high level of cash flow within the portfolio, and we're continuing to add either assets that are cash flowing directly or assets that are going to be cash flowing within the near term. And that's really the focus for us. Pure play royalty and streaming company with a high level of cash flow and focused on near-term growth.
And Joe, what percent of your revenues come from gold and what percent comes from silver?
So we're a pure play company, so very high percentage when it comes to the metal mix within the portfolio. Right now we're about 80% gold, just over 10% on the silver side. And the remaining exposure is we have one copper investment on the Caserones mine in Chile. So, very limited exposure outside of precious metals. And it's something that we want to maintain, all right? We want to make sure that our investors, when they buy Nomad shares, they're buying exposure to gold and silver. So every now and then, if there's small investments on the copper side, we may look at them opportunistically, but this is primarily a gold and silver business.
Joe, you recently announced a $95 million streaming deal with Greenstone Gold Mines, which is a gold mine located in Ontario. It's currently under construction and it's ramping. And as it ramps, it's going to become a major component within your portfolio. But why don't you give us an overview of this asset and also of the deal?
Yeah, we were really excited about that acquisition. It was our first major streaming transaction that we announced within Nomad. It's something that we've been wanting to do since launching the company because fundamentally our team, that is our bread and butter. That's where our experience lies, is these project financing type situations where we can come in and structure tailored financial products for operators that are building mines like this one. And this mine is very exciting. It's, for those of you who don't know Greenstone, it's in Ontario. It's about 275 kilometers north of Thunder Bay. Once it's up and running, it's going to be one of your very typical Canadian bulk tonnage mines. It'll be producing about 400,000 ounces a year, placing it at, at the top end of mines in Canada. But it's in construction, fully permitted. It's operated by Equinox. It was a very unique transaction for us because this mine's owned in a partnership between Equinox and Orion, and we streamed the gold from the Orion interest. They own a 40% interest in the mine. And for those of you who don't know, Orion is a large shareholder of Nomad, so they're a partner, and they're helping us build out our business. And this is a great example. We're able to provide $95 million of stream funding. Perfect type of scenario where we're coming in with the financing. As soon as we close the financing, they're off to the races building the mine. And we expect this mine to start producing in 2024. And It's a $95 million investment. We're going to deploy it in stages. The first tranche paid on closing was $13 million, and the remainder will be funded as the drawdowns occur under the debt facility to build the mine. But once it's up and running, it's going to deliver 10,000 ounces to our portfolio. So it's not going to become a cornerstone asset within our portfolio, but it will deliver significant growth versus the level of production that we have today. And that's what we're aiming to do with these types of deals. We're adding diversification to the portfolio. In this case, a great operator, a great jurisdiction, Canada, but helping to diversify the portfolio overall without being overweighted to one asset, but delivering that near-term growth, which is really the key for us when we look at deals.
And so when you say when it's up and running, it's going to give you 10,000 ounces, just put that into perspective for us. How many ounces did you obtain last year?
So currently, since we listed, we've been at a run rate of about 20,000 ounces a year. This is approximately. So that 10,000 ounces is a very meaningful step up in terms of our annual production. And we'll go through some of the other assets in the portfolio. 2024 will be a big year for us in terms of assets coming in. But this stream alone will represent a very important step up for us.
And Joe, you also mentioned that Orion is a shareholder of Nomad Royalties. What % do they own?
So Orion has been a partner from day one. For those of you who follow the story, we initially started by acquiring a portfolio of royalties and streams from Orion and Yamana. So since the get-go, they've been a very large shareholder, very aligned with us in terms of the strategy building out the company. They are a long-term shareholder, and we are diluting them down as we grow the business. But currently, they sit at about 65% of the shareholdings of Nomad.
Joe, the second deal that was recently announced was Ivanhoe's Plante mine, and it was unique in that it was done in conjunction with Orion, and it was total amount was for $300 million, of which Nomad put up $75 million. Why don't you just give us an overview of this deal and also of the asset? Yeah,
so another really amazing deal for us, and they happened very close to each other. This was a longer deal in the making. Took us about a year to get this to the finish line. Just because it was a more complex situation, there were more players. We were deploying into this investment with Orion for a total check size of $300 million, $75 million of which was written by Nomad to acquire a portion of the gold that was part of this stream. And Plante is a really spectacular asset. And maybe I'll start by saying, when we started the company, we didn't necessarily think that we'd have the opportunity to buy streams like this. So, the fact that we have, I think, shows the types of situations we've been able to get involved in, partly through our own, our own work, but also because we have a partner like Orion, and we can attack bigger situations alongside them and co-invest. But Plante is really one of the best undeveloped PGM mines in the world. It's owned by Ivanhoe, who are, truthfully one of the best partners we could have on an asset like this. They've just come off building a major mine in the Congo. They're not going to be focused on this one. I had the opportunity to visit this mine in November. I was very impressed with what I saw on site. It's a mine that's already has one shaft up and running and operational. They're currently sinking the second shaft. And essentially the opportunity for us to come here came because they went from a full-scale development on that mine into a phased approach, where they're going to ramp up to a smaller level of production, and then over time expand this mine up to its ultimate run rate of 5.2 million tons per annum. And so with Orion, we're able to provide the financing for them to start this initial phase, which we expect will start up in 2024 and then subsequently ramp up to that higher level currently by 2030. But we do think there are opportunities to shorten that timeline. And in fact, Ivanhoe is working on a feasibility study, which they're going to release this year, which may look at ways that they can accelerate that development, which would be incremental to our investment in this asset. But at its highest peak, this gold stream will deliver to us 12,000 ounces per year of gold. So again, another very meaningful chunk, in terms of growing out our revenues. It's in a bit of a longer term, in the longer term, just because of the phased approach. But nonetheless, a very important asset now for our portfolio. And again, it's a $75 million investment. So it's not our cornerstone asset, but it comes in and again, adds more production to the portfolio, continues to diversify, adds a really high quality operator, and fundamentally shows with a partner like Orion, the types of deals that we can deliver.
And so I'm curious, when you said you actually went to site in November, did you have any issues getting into or out of the country?
None whatsoever. What I saw was a country that had really put in place very strict procedures dealing with anything pandemic related. And that was true as much the airport, at the hotels, at the restaurants as it was on site. So gave me a high level of confidence that this will not be an issue in terms of the development of the asset.
Joe, let's move on to another asset, which is also in South Africa, and that's Bloor. It had a slower than expected ramp up. Maybe you can just provide some details on that.
Yes, absolutely. So Bloor is one of the assets that came in the initial portfolio we acquired from Orion. And just as a reminder, this is really a phenomenal asset. It's a mine with a rich history. It's produced over 45 years. It produced over 38 million ounces over that time frame. So it is a very significant deposit with a lot of gold remaining. It's being started up. It's been in a ramp up over the last, essentially since March of last year. They have encountered delays, initially pandemic related delays. Recently, we've announced further delays, really just as a result of the development process. And what I mean by that is it's a mine that's fully built. It has a plant that's fully built. It has 200 kilometers of development underground, but it's a team that's going back underground, after the mine has been shut down for a while. So re-equipping new stopes before beginning production, that has taken a bit longer than what was originally anticipated, and that's what's resulted in a delay. It's a mine that I also was able to visit in November. We've had some of our members of our team go back in January. We're still very happy with this investment, and we truly believe in this mine being able to deliver in the long run and have no concerns over that longer term potential for the mine. But we are now facing a slower ramp up than what we had originally anticipated.
Another asset I want to ask about is Barrick's Robertson mine, which is an extension of the famed Cortez mine. And they're doing extensive exploration work there, and they're trying to expand that resource. Why don't you provide an update on that asset?
Yeah, Robertson is probably one of the assets that has the best potential within the portfolio to surprise us positively. It's an asset that we acquired last year through the acquisition of Coral Gold. It's a 1 to 2.25% sliding scale on a very key part of ground that forms part of Cortez. And if you follow Cortez, and if you followed some of the disclosures from Barrick over the last 24 months, Robertson is getting a lot more airtime in terms of when we get a glimpse into the operation. They're talking about very exciting plans for this specific property, and they're drilling at surface. There's many targets on surface that they have been disclosing new results, and in fact, at their latest Investor Day presentation, they're not confidently saying that the mine is growing towards that initial 4 million ounce target. But they're also not talking about the deeper exploration happening on the Robertson property and in the trend from pipeline to Robertson, most of which will fall on our royalty ground. So we're looking forward to seeing a lot of results from that work. In our opinion, this is a fantastic royalty for our portfolio because it delivers near-term production. They're talking about the development of the surface oxides and bringing that into production by 2024. They're talking about 250,000 ounce a year production level for an initial 10-year life, which in their estimation qualifies it as an emerging tier 2 asset. but with the potential to grow into a tier 1. But then there's the wild card of what happens in that deeper exploration. And that's what we're following closely. And that's why I say, probably one of the assets that's the least understood within our portfolio and gets the least value within the analyst community and within the market, but has a really good chance of delivering some spectacular results. So a well-timed acquisition on our part. And ultimately, we think this is probably going to be one of the better royalties in the royalty space once we see some of the results come out.
Joe, that's a great overview of your various assets. Now let's move on to your balance sheet. You recently did a $40 million bought deal. BMO was the lead. Give us a little bit of color on that. What were the use of proceeds and how did the deal go?
Yeah, it was a really good financing for us. We ended up closing at $42 million, so a bit oversubscribed versus that initial $40 million base. Keep in mind, when we started the company, we started 10 days before the global pandemic started. So this is the first real financing, I'd say, that we've done within Nomad in terms of bringing out outside capital, outside equity capital. So something that we've been wanting to do. We had done a number of acquisitions funded on the credit line, on the revolving credit facility, namely Caserones. So that equity financing or the proceeds from that financing are going to go to pay down the credit facility, which will then subsequently be used to fund the remaining milestone payments on the Greenstone and Plante streams. So we were happy to do it. It's something that we need to do in terms of building out our company, in terms of building out the shareholder base. And what was nice about the offering is we got a really good mix of large US funds as well as retail shareholders, a very high retail component. So it's going to add incrementally to our liquidity. And keep in mind, it's a $42 million deal that represents about half of the float that we had prior to the transaction. So the impact that it's going to have on our trading and liquidity is very significant.
Joe, as we wrap up, what can investors expect in terms of news flow from Nomad Royalty in the coming months?
Well, if you look at what we've done so far, we've really been focused on building out the company and to a certain extent, a proof of concept, showing that our team can uncover very large transactions, grow the scale of our business, grow the quality of the portfolio, act, with our partner Orion in terms of enhancing that quality, enhancing that deal flow. And where we sit today, I'd say a lot of that heavy lifting is behind us, and we have proven the concept that we can deliver on growth and we can deliver on what we said we would deliver when we started the business. So from this point on, there's obviously very exciting things within the portfolio that we're keeping a close eye on. I think the feasibility at Platreef will be an exciting moment to see if we get to see that higher level of production sooner within the portfolio. But then just new transactions, and that's really where we can deliver value within a royalty company setting, is new transactions, deploying capital into new and interesting situations to create value for our shareholders.
Joe, that's a great overview of Nomad, and I want to thank you for spending time with us today. And to all of the viewers, if you have any further questions for Joe and his team, please send us an email to info@bloorstreetcapital.com. Once again, Joe, thank you.
Thanks very much, Jimmy.
Hi, David. Thank you very much for joining us today. How are things in Vancouver?
Very good. A little bit foggy this morning, but it looks like it's going to be better.
Dave, 2021 was a big year for Sandstorm Gold. It was a record year in terms of acquisitions. You deployed over $200 million. You also initiated a dividend policy, and you recently released a feasibility study on your primary asset, Hod Maden. And I want to discuss all of these elements in detail. But before we do that, why don't we just start with a brief overview of Sandstorm Gold?
Yeah, listen, Sandstorm Gold is a streaming and royalty company. We've been around since 2009. The company was founded by myself and Nolan Watson. And together we've done more transactions than any other management team out there. Nolan's the most long-standing CEO of a royalty company right now. I think the real thing that sets Sandstorm apart from everybody else is, I think, the creativity, the structure of the transactions, and really, I think the tempered growth that we've had going over time. 2021 was a great year for us. It was a great time to deploy capital. That being said, we think 2022 is probably going to be even more transformational and a bigger change in really what Sandstorm is going to look like by the end of this year.
And Dave, how many assets do you have in your portfolio, and how many are producing assets?
Yeah, so we're at over 230 assets in the portfolio right now. We're at close to 28 or 30 of those are cash flowing today. There's a couple more coming online, small ones, albeit, in 2022. But really what we have is overall portfolio that's focused on the growth of that cash flow sector, but a lot of that great optionality sitting in the background.
And we're going to get into that. Before we do, you recently released your Q4 and your full year gold equivalent ounces, or GEOs. Why don't you just give us an overview of those numbers?
Yeah, listen, we hit kind of towards kind of right where we thought we were going to be on the overall production numbers for it. We're in the sales of it. We anticipate that as we get into 2022, some of those mines that are kind of lagged behind had pretty good quarters in Q4. So we expect to see that reflected in our Q1 of 2022 as we get into it. So in the end, I think overall, we're pretty happy where we ended up with in the full year of 2021 and in Q4. But as we get into 2022, we certainly hope that there's not only going to be a good match to those numbers, but probably an increase as we continue to make some acquisitions here in the space.
Dave, as you mentioned, your single largest investment is a 30% investment in a gold copper project in Turkey called Hot Maden, and you recently announced a very positive feasibility study on the project, which proves up the economics and all the scalability of this project. But before we get into that, why don't we first look at the country in which it resides in, and that's Turkey. And a large part of your job is removing risks associated with mining assets, and yet some people might look at Turkey and think it's a very risky country to operate in. What are your thoughts on that?
Yeah, listen, I think at the high level, Turkey has had issues really kind of around some of the economics that are going in. They are currently going through a big currency devaluation. That being said, you know, it's been a very functional country for mining. There's currently 18 operating gold mines. There's a couple more mines that were permitted in 2021, including really the bulk of the permits for Hod Maden, our project as well too. And so certainly at that high level, it looks risky. When you do see it, the currency really devalues so much and at a rate that it did in 2021, this certainly seems scary from an outsider looking in. That being said, you know, mines are very well situated. They function very well. In fact, lots of foreign companies and Canadian companies operate mines in Turkey, and it's worked exceptionally well for all of them. They've never had any problem with exporting concentrates or selling their gold or doré that they might produce at those projects. And they tend to be very good operators. You know, the big advantage, I think one of the big advantages from that macro picture on Turkey is that it really is a manufacturing center. So the one thing that really saves a country like Turkey when you see that huge inflation and that devaluation is that it can really focus on that manufacturing center. That translates really well, I think, onto the mining side as well too, because the products that mines are producing are sold at US dollars. and transacted at US dollars, whether or not you're selling gold or you're selling concentrate, which is really what hot matten is, you end up getting paid in US dollars, which really, to a certain degree, plays to your advantage, even if there is some really excessive and high inflation and currency devaluation. You know, the nice thing about Turkey, and once this project gets up and going, which is not dissimilar from any of the other mines in Turkey, is that the bulk of your costs are denominated, your ongoing costs, operating costs are denominated in Turkish lira, but you're selling a product that is in US dollars. You take a look at a lot of the mines that have started up recently with the various different companies there, their operating margins are really good. The existing mines that are in there, their operating margins continue to really outperform in the market. So I think that'll be the case too. You know, we've gotten the go-ahead. We've got our EIA approved. We're still waiting for some of the final permits, but we're really on track and confident that we'll be able to, with our Turkish partner, get through that construction phase effectively and in a timely manner.
So let's move on and let's look at the project itself, Hot Maden, beginning with the highlights associated with the feasibility study. Why don't we just start with the net present value, the internal rate of return, and also the payback?
Yeah, we ended up with a net present value that's over $1 billion on it, and a very high IRR on the project with overall payback within 2.5 years on it. Now, it's a very similar in terms of looking at the cost and the difference between the PFS and really where the feasibility study laid. The overall costs, this just over $300 million, very similar to really what we saw in the PFS. The operating costs on the long hole open stoping, very, very similar sort of operating costs between there. The big difference between the two studies is the implementation of this drift and fill. So the drift and fill is the very, very upper part of the ore body as it gets close to surface, and looking at mining that through what ends up being a pretty expensive method. So I think the determination between here and production is really trying to accommodate that drift and fill area that's near the surface in something that might be a little bit more and bring those costs down. Once we do that, or if we're able to do that, we'll start seeing, I think, overall NPV that's closer to the $1.4, $1.5 billion that we saw, our pre-tax NPV that we saw in the PFS. So overall, the project hasn't changed a whole lot from the PFS to the FS, which I think is good. Because it's such a high-grade project, because it's in an area that has a lot of infrastructure available to it, certainly we are seeing inflation creep into our space and into a lot of these projects. But because it's particularly small mine relative to many others, that those inflationary pressures shouldn't be as high as what we've seen in other projects, especially considering it'll be producing close to 200,000 ounces or over 200,000 gold equivalent ounces in the future.
And one of the things that really attracted you and your team to this project was the gold was so high, or the grade was so high, but the copper grade was also very high, which makes this project very unique. Maybe you can just speak to that.
Yeah, listen, I mean, some of the latest geotech holes that came into this that were disclosed over the last couple of years really kind of tell the story. 85 grams per ton over 85 meters, including 6.8% copper on it. You know, when you see those types of eye-watering grades, you typically associate that with fairly narrow ore bodies. The difference between those types of ore bodies and what we have at Hot Maden is you have this, you know, almost a rectangular prism. You know, imagine a little bit of a cereal box, if you will. That's 400 meters deep. It's about 350 meters long, and it's about 40 meters wide. And that's really all filled up with really this positive mineralization that has a lot of copper, a lot of gold. It's a relatively easy mining method. When you have an ore body that's wide, you don't have to worry so much about dilution. It's pretty consistent grades throughout the overall project. So that's what I think really gets, I think, anybody excited, not just us, about this project. It's kind of like a mining engineer's dream when you think of being able to design those stopes, mine those stopes, report it to the mill without a shaft. It's a pretty simple operation once it gets up and going, and probably has that benefit to surprise to the upside, depending on really where the grades go.
And why don't we just touch on the all-in sustaining cost too, which really speaks to the both copper grade and also the gold grade.
Yeah, listen, it's going to be, one of the in the bottom quartile of costs. We're going to see costs that are likely under $500 per ounce on a co-product basis, or around $350 per ounce on a co-product basis, or on a byproduct basis, and certainly around $500 per ounce on a co-product basis. It really is a remarkable deposit. I think if we can improve the mining method for that top section, you could potentially see those prices come down, even in an inflationary environment.
And Dave, why don't we move on and just look at the permitting or the permits that are left? You recently also got the EIA. And what other permits do you need before you can start the construction process?
Yeah, I think that's really kind of one of the very positive things that happened last year. EIA is the key permit that you really require to get the project up and going. That got through the process very well. It had 0 negative comments or public comment on it, which is really remarkable in any jurisdiction, and especially in Turkey as well too. So it's gotten through that process really well. The last permit we're waiting for is a forestry permit, which is probably a few more months out. But comparing it to other projects in the country that have received their permit, it's a lot easier, the process getting through this. So it's a matter of really kind of dotting your I's and T's from this point. Next stages in terms of timeline are really putting together the financing, getting the EPCM contractor lined up, and really doing that detailed design. But I'm really hoping that by this time next year, we're really into that full construction mode. Other items that I think will happen in 2022 are some of the early construction processes. So there's, although there is a paved road that goes up to the project, some upgrades need to be done. That needs to be done. They'll start on some of the tunneling and some of the portaling of these areas, which will get everything off on a good start. So almost all those permits for that early works are already in place. We're just really waiting for that forestry permit. But with any luck, at this time next year, we're well into the start of the construction of the project.
So things are really moving ahead here. So as we move in toward the construction phase and eventually into production, what are your plans? Do you want to continue on being an equity owner in this mine, or do you want to somehow move it toward a royalty or streaming agreement?
Yeah, listen, owning the equity interest, I think would still be great for the company. But I would guess that by the time we get towards the end of the year, we'll have converted that equity interest into something that looks more like a very plain vanilla stream on the project. So that's something that we're actively working on in a couple of different fronts. But we certainly do have that goal of transforming Sandstorm into really a more pure streaming and royalty play in the future.
That's good. So I want to move on now to some of your other assets, seeing how you do have 230 of them. But you recently announced an agreement, a royalty agreement with Mercedes Mine. Why don't you tell us about this? Yeah, this is a little bit a new way of doing deals with us. What we're doing and what we did with Bear Creek is we helped them purchase a project from Equinox Gold, which is, it's a good little project, probably too small for a large company like Equinox to really have their focus on it, but a really good project for a company like Bear Creek, which has some great technical knowledge, a couple of very great assets in the background, but now we'll be focusing on their first producing asset in their portfolio. So this was an opportunity that we worked on with Bear Creek to make that acquisition. And this is, I think, a strategy you can expect us to see us deploy a lot more often in the future as we build up relationships with Bear Creek and other companies in the industry
where we help them acquire producing cash flowing assets. In terms of really where Mercedes fits in our overall portfolio, that's kind of exactly it. We're looking for a real portfolio effect. What Mercedes does for us is it helps really plug in a lack of production growth until we get Hod Maden up and going. That being said, this is a really quick payback project for us, but still has those hallmarks of what we look for in a transaction, which is good exploration upside that really hasn't been tapped into yet. So that's one of the big benefits of doing this deal with a company like Bear Creek, is that they can focus, and they have that focus on exploration and expansion of projects, which is something that we certainly see happening at Mercedes, taking it well beyond a 5 to 7 year mine life out to, this is another project that wouldn't be surprising if it was producing another 15 to 20 years from now.
I want to move on now. You also own a number of investments or equity investments, one of which is Entrée Gold. We've had some positive news out of Mongolia recently and Turquoise Hill. Can you just tell us about Entrée Gold and your investment in the company and what your intentions are?
Yeah, listen, we're big believers in that project. We know it's really kind of a long-term wait, but the wait in this case is absolutely worth it. The great news this week is that the Mongolian government and Turquoise Hill have come to agreement on really the cost overruns and really how to split that up. And so now for Turquoise Hill, for Rio Tinto, is full steam ahead in developing that underground, the underground production on that, which means the quicker it gets into there, the quicker we get the pan. We've been buyers of Entrée for some time. We love it as an investment. We still have that gold and the copper streams on that Oyu Tolgoi joint venture area that Entrée is a party to. So that's a great value added to her. But we certainly like the idea of owning that stock. We see it as still continue to see it even with this bump post the good news with the Mongolian government. We still see it as a great investment, and we'll look to add to that when it makes sense.
Dave, I want to move on now and discuss your balance sheet and capital allocation. One of the major policies that you implemented in 2021 was the announcement of a dividend policy. So I want to touch on that. And I also want to know how you're going to implement the dividend policy in conjunction with your buyback program, because you and your team are quite active in the buyback of your stock when it's trading at a discount. Can you speak to that?
Yeah, for sure. Well, I think 2021 really marked the year where we saw a substantial boost in overall cash flow for the company, both by more production coming on and really seeing the growth and the increase in the commodity prices. So we have really been the laggard, and I think in that dividend policy, in terms of really the mid-size and even compared to some of the smaller royalty and streaming companies. So that's something that I think was destined to happen, and we finally got it in place here at the beginning of 2021. Now, it's not a huge dividend by any means, but we certainly do see ourselves finally in that space where we can do everything we really want. We've always focused and seen ourselves as a growth company. We'll continue to see ourselves as a growth company first and foremost. But even with this dividend policy in place, we still see ourselves cash flowing enough to be able to obtain the growth and continue the growth that we hope we're going to get. And also be able to implement that share buyback when it really makes sense. We've always been active on that program, especially in the last 4 or 5 years. We've bought back well over 10% now of our overall outstanding stock over that period. And it continues to be something we like it. It's a good way to really pay back shareholders in a tax-free way. But now we've got that dividend that helps really kind of see some income come to shareholders, which hopefully broadens up that base and really can attract a couple more people into I think what's an exciting story.
Dave, I want to move on now and ask you about the pipeline. Are there a lot of deals being shopped out there? And if so, what size?
Yeah, listen, like I was talking about before, that it's a very competitive space here. And the one thing that we don't want to get caught in is really just this idea of getting sucked into competitive bidding processes by the bankers on this. That's never really been a big part of our game plan. through different parts of the cycle, we've been really kind of had parts available to us, either on the smaller or the medium scale of streams and royalties. But now with the influx of so many companies, that's been challenging as well too, and something where there's a lot of competition on. So now we're going down the path of more of a process of really manufacturing our own streams and royalties. A very good example of that is that Mercedes transaction with Bear Creek, where really we're getting, I think, a very good return on a deal by really approaching a company and talking about doing an acquisition of projects. So it's that type of methodology that I think you can expect us to see, not just with Bear Creek, but a number of other different companies. So far to the point that we might even really kind of create companies alongside of us that are specifically set up there for the idea of manufacturing streams and royalties for us. It takes a lot more work, but we've got a great corporate development team. We've got a great team here to be able to implement that. And if it means getting better returns, then it's absolutely worth it to proceed that way. So when you talk about really what 2020 or 2022 will look like for Sandstorm, I think we're probably going to get, again, a record in deals getting done, transactions being done. Really streamlining Sandstorm as that diversified streaming and royalty company, but still getting good deals that are hitting all those marks for us, which is cash flow now, good exploration potential, and growth, building out that growth curve in the future into the end of the 2020s and into 2030s.
Dave, I want to move on now and discuss valuation. Sandstorm has a lot of things going for it. It is a very diversified portfolio of 230 assets spread all over the world. You got a decent market cap, you trade in New York, you're cash flowing, you pay a dividend, but yet it's trading at a discount to a lot of your comps. It's trading at a discount to NAV. How do you explain that, and what do you think the market is missing?
Yeah, I think a lot of the changes that we needed to really kind of get us back into the space have happened. So we've got the dividend, which is happening right now, which puts us more on par with the largest and best trading companies in our space. And then also, if we are successful in getting this conversion from the equity piece of Hod Maden into more of a plain vanilla stream, that's going to help as well too, really lining us up as more of a pure play royalty and streaming company. And then of course, really deploying capital and getting more deals done. We have great diversification right now, but more will help in getting more deals doing and really kind of solidifying up that growth as we go towards the end of this decade and in towards the next. So really that is the goal, is to deploy the capital that we have available to us in good creative ways to get good cash flowing deals on significant assets that will increase the diversity of our portfolio.
Dave, as we wrap up, what can investors expect in terms of news flow in the months ahead from Sandstorm Gold?
Yeah, I have hopes that 2022 is probably going to have the most news flow and most changes in the company since almost the beginning of it. With really the proceeding of Hod Maden into that early stages of construction will be great. The idea of really doing some kind of conversion of that into more of a stream will be important as well too. But certainly on the lookout for more deals and transactions, and I think creative ways of really approaching and getting good deals is what you can expect from Sandstorm and what I hope happens for the company in 2022.
Dave, that's a great update on Sandstorm, and I want to thank you for spending time with us today. And to all of our viewers, if you have any further questions for Dave and his team, please send us an email to info@bloorstreetcapital.com and we'll get you an answer to your questions. Once again, Dave, thank you.
Thank you, Jimmy. I really appreciate it.
Hi, Shaun. Thank you very much for joining us today. How are things in Toronto?
Hey, Jimmy. Good. Thankfully, it's stopped snowing and the sun's shining, so pretty good, thanks.
Shaun, Triple Flag recently released its gold equivalent ounces or GEOs for 2021, and it was up 33% over 2020. But before we examine why the strong performance, why don't we begin with a brief background on Triple Flag, because it's a relatively new company just going public in 2021.
Yeah, thanks, Jimmy. As you say, I think for the public eye, it's a new story. We'll celebrate our anniversary in May, a listing in the TSX. But we're entering our 6th year, so it doesn't feel so new to me. Because just to reorient you, I mean, we started off without any asset spin-outs. It was really with a partnership with Elliott as the capital provider, clean sheet, myself, and then building a team from scratch, really looking to fund, financing priorities for the mining sector and to compete with the largest in the space to build really a precious metals focused streaming and royalty business. And 5 years on, we actually viewed 5 years as the natural time when we'd have the scale to transition and increase our ownership base. And it's pretty much almost to the month how that's panned out. But we've got 78 assets, 15 producing. And to your point, we've had successive years of year-on-year ounce growth, very tangible, substantial ounce growth, 26% cumulative annual growth rate, and one of the biggest and longest duration portfolios in the sector. So that's our story.
Shaun, as you mentioned, your single largest shareholder is Elliott Management. Some people might not be familiar with who they are. Maybe you can give us a little bit of background on Elliott.
Yeah, Elliott was a really key feature for me in deciding to sort of leave Barrick to start this. And part of that is, I think it's quite unusual in the space to find, I think they've got something like 50 billion AUM at this point, so they've got substantial firepower. And really, they've got an infinite time horizon, which I think in the mining space is so important. If you've got a private pool of capital that has the ability to be able to see long-term, really think through the risks and ambiguity, which really they've demonstrated, and has a track record of a group like that, I think it's not quite a unicorn, but it's quite unique. And so when I fast forward with Elliott, they've had something like a 13.5% cumulative annual growth rate over more than 40 years in business, with I think it's like a third of the volatility of the S&P. It's an incredible track record. And I think over that period, they've had like 2 single-digit down years in over 40 years, including in the global financial crisis. So it's an amazing track record. So to be able to partner with some of the smartest money in the world, really to enable us to compete with the largest in the space out the gate, was part of the founding idea that was so compelling for me.
And maybe you can just explain their rationale for entering into the royalty space. Is it because they like precious metals, or did they like their royalty model?
I think it's both. So, it's quite well publicized. I think Paul Singer and the Elliott team like precious metals exposure as part of their overall portfolio, just having a reasonable weighting in that. So you're then into the realms of holding physical with the costs associated, obviously ETFs with the costs associated. With the equities, that model can provide leverage at certain times in the cycle, but you look back and you think about some of the capital allocation mishaps along the way, and some of the consequences of that. Plus, times like this, when you see significant inflation, the equities are really, they struggle in inflationary environments, whereas this model and the optionality that it has through participation in future exploration success, expansion, and that was the sort of compelling part, gaining that exposure, and indeed, getting to participate with a dividend over time. So I think they love the model, but they also like the gold exposure and the opportunity to be part of building a Franco-like business without the oil and gas exposure was the genesis of this business.
And one more question before we move on and examine your portfolio of assets, but I'm curious about the name Triple Flag. What's the significance of that name?
No, it's personal. It's in some ways just a homage to the mining sector. It's global. Obviously, I've worked in so many countries, but I've lived in 5 through my career, and my 3 children are born in 3 different countries, one of which is Canada, the UK, and South Africa. So 3 flags, 3 kids, a sign of the nature of the industry and the family nature of our business.
That's a great story. Let's move on now and look at your portfolio. Your single biggest asset in your portfolio is North Parks, which you acquired in 2020 for $550 million. It's a gold and silver stream in Australia. Why don't you provide us some background on this asset?
Yeah, North Parks, we feel so privileged to have been successful in securing that. It's a copper asset with we stream gold and silver as byproducts. I think when you look at our portfolio, it's one of the characteristics, having worked in base metals in addition to precious, that we really identified as an opportunity, and I still think represents a huge opportunity for the entire sector as well as ourselves going forward, because there's just this natural arbitrage. Like, those gold and silver ounces are non-core to those businesses, and those multiples that when they're in our portfolio are just greater. So we can share that cost of capital arbitrage with those producers with something they don't covet. So here you've got an asset that's located a few hours from Sydney, Australia. It was actually the first fully automated underground mine in the world. Very sophisticated, great ESG practices. They first discovered it or started operating in 1994. And at that time, they had just under 70 million tons of reserve. And you look at it 25 years later, they got nearly double that in reserve now, and nearly 500 million tons of resource. And it's an asset that really has decades of life ahead of it. You don't tend to find gold mines like that. So for us to have a cornerstone stream and to think about it in the context of our little over 5 years of operating, it's still the largest precious metal streaming deal that's been done since our founding, which we're very, very happy with. They've got great ESG credentials. It's an ore body or series of ore bodies that really hasn't been explored much below 200 meters, where it has been extensively drilled. So the potential for these porphyries to be discovered below, we think, is significant. And for us, we've just actually enjoyed our first full year of ounce contribution from that. That's contributed to that 33% increase in ounces that we enjoyed on last year's record. We've also seen just the exploration potential starting to reveal itself. You would have seen their announcement on E44 and the permitting. The actual footprint of that very large reserve that they have is only on 26 square kilometers. Our stream is actually subject to the full exploration potential there, which is over 1,000 square kilometers. So we're very excited about that. And I think over and above, as they are expanding, they're expanding at the moment to 7.4 million tons per annum throughput. They're well advanced with that. We'll see that go up slightly as they get to E22 or zone E22. And as they enter E22 and E26, those are at higher gold grades. So I think in a few years' time, that's some additional increase in ounces that we look forward to for our investors.
And you mentioned that it's going to be producing for decades, but what's the mine life on this asset right now?
You need to look at what the analysts are. You can think of it as certainly what the analysts have put out there is something closer to 30 years, I guess, at this point. I don't know the exact numbers. The management team on the ground, if you look at it, we've put out a virtual mine tour, which I'd encourage anyone that's interested to take the time. It's on our website. It'll just give you a sense of really the quality of this operation. But you'll see they talk about a century of mining. That's the time horizon these guys are thinking about. And when you think about nearly 500 million tons of resource before they do any additional exploration, it just gives you a sense of what's likely beyond what's captured in the next few decades of mine life that the analysts are recognizing.
So let's move on to another asset. Another significant one in your portfolio is Nexa's Cerro Lindo mine, which is located in Peru. You paid $250 million for this asset. Why don't you provide an update on it?
Yeah, it's it's so important, I think, as a new business to obviously get your first meaningful transaction on the board. And we started our business in May of 2016. In the end of our first full year, to have closed that deal was a very important thing for us. 250 million, as you mentioned. Part of what we recognized at the time we did that diligence was the business that had started off in 2007 had been built very sympathetically to its communities. So in a dry environment, all their water is provided through desalination. It's got a pipeline that takes this at about 1,000 meters above sea level with a private road. And they've actually used dry stack tailings as well. So they've been very sympathetic environmentally to the actual foundations, and then of this operation. And then indeed, over time, they've had this beautiful track record of low-cost expansion and reserve replacement. And you see that in the 5 years now, a little more than 5 years that we've had it. So, you know, in that period of time, we've streamed a little over $150 million worth of silver. And, you know, they've got the same silver reserve now as when we did the deal more than 5 years ago, which is exactly the sort of thing that obviously you look for in this in this sort of business model. So we're really impressed and pleased with how the team has performed and how they continue to perform. They've just recently done, you know, some really good work on exploration, which has shown, you know, some further expansion, not just of contiguous areas, but indeed areas that we are exposed to, and it shows both thickness and continuity of some of the zones. So we're very excited about that.
And Shaun, just so I have my numbers correct, you paid $250 million for it, but it's already paid back $150 million. Is that correct?
It's 150 and counting. Yeah, that's right.
So let's move on to another large asset in your portfolio, RB Plats, which is in South Africa. You paid $145 million for it. It's a gold stream. Provide us with some background on this asset, please.
Yeah, this you know, this is the culmination of really our approach to trying to uncover opportunities, and I think increase the maturity of this from a funding to the mining sector. So we proactively looked at byproduct streaming opportunities in the region, particularly with PGMs, where gold is not the core focus. We looked at ESG track records, and as a consequence, we'd identified a couple which we saw as priority opportunities. RB Plats was an obvious one for us, and it started off as a conversation on the side of a mining conference in Barcelona. Months later, then we put an idea, tangible ideas in front of the management team to really replace high-cost debt. And we're really proud to have helped work with that management team to do that, to pay down high-cost debt, and to take a small byproduct and get a very high-quality stream for our investors. So this is something when you look at it, and I'd encourage any of your viewers who are interested, we've just done a virtual mine tour there as well in December that's on our website. And I think what it does is it uncovers not just this highly capitalized and mechanized mine that took over 10 years to develop to the point that it's at now. So Staledrift is in the late stages of hitting commercial production. We're still seeing it ramp, and we'll continue to see for our investors, you know, those gold ounces go as they hit their commercial production. But visually, just look at that video and you will see how, I mean, this is a former Anglo-American joint venture, and it also highlights just how ingrained the ESG leadership is within this operation, which was part of what appealed to us. There, so the Bafokeng, this is like their sovereign wealth fund. They built schools, you know, housing for their employees in the communities. We put scholarship programs in to help support them with their privilege to operate, and you know, they've just really gone from strength to strength. This is some of the last of the Shella-Merensky high-grade ore bodies on the Bushveld Igneous complex, and you know, again, you've got a multi-decade high-margin investment for our investors that, you know, we're really are very happy to have. And again, that I think that that virtual mine tour showcases it really well.
That's a great overview of your larger assets. I want to move on and just look at some of your smaller ones, beginning with Step Gold, which is in Mongolia. And they recently announced a phase 2 expansion program, which is going to extend the life quite significantly. Why don't you give us an update on this asset?
Yeah, so the, you know, I think it probably is a really good showcase of the capability of this team. It's really operated, as we said at the start of this, all over the world. And I think part of that is the ability to source these opportunities, but it's one thing to commit capital, it's another thing to get money back and make sure that, you know, you've applied good judgment in the application of your financing decisions. So, you know, this, I think was our second transaction. At that time, you saw this land that had been extensively drilled by Centerra. And what we did is we committed less than $30 million of capital to a management team that we diligenced really carefully, that had a great track record in country. It's Mongolia, so we sized it, you know, very thoughtfully and structured it commercially in a way that ensured that we, you know, were secured, had a good high rate of return, but where we could be enabling to this team to take on that risk capital and bring this mine into production, which they did very successfully in the early stages of COVID, which is no small feat, and they hit commercial production very quickly. You would have seen in Q3, they did announce that with the COVID supply chain disruption, they have had challenges getting reagents across the China-Mongolia border, but they've continued to mine. So there's a time delay associated with that. This is a simple series of small open pits and heap leaching, very conventional with the oxide that's there. But you'll see that they've got something like 45,000 ounces that's crushed and sitting on the pads waiting for reagents. So I think as soon as they get that, you'll see those ounces in the cash flow accrue. But to your point, in Q3, they released their fresh rock study. None of our investors were focused on that. We didn't foreshadow it, even though we expected it to be coming. And you'll see that that's added nearly $100 million of NAV to our shareholders, and it's extended the life on that asset by just over 10 years. They've already secured on the 130 million of capital, 65 million from TDB, and they've done an incredible job. They're already in execution mode with the new crushing capacity, and they're advancing quite well. So a great example of this model, the ability to provide risk capital, to be patient, and to support the sector.
Another small asset in your portfolio I want to touch on is Talon Metals. Tesla recently signed its first U.S. nickel supply agreement with Talon Metals for 75,000 tons of nickel. Can you give us an update on this, or just provide an overview of that story, please?
Yeah, look, we're really proud of the association and that team. If anybody has followed that story, they've been consistently impressive with their results. Our association goes back a few years now. We put only $5 million into securing a royalty there. And for us, this is at a time when nickel wasn't in vogue. We focus on gold and silver, but our non-core part that we do focus on because of our backgrounds, I was CFO of Xstrata Nickel, and I've worked in Xstrata, BHP Billiton, and others, was really, the battery metal thematic before it became as prevalent as it is now. We helped with that 5 million, the Talon team secure their entitlement in their joint venture with Rio Tinto at an early stage. They've really gone on from strength to strength, and you will see, I think their resource is only on 750 meters on something like 13 plus kilometers of strike. So we did view this with the work we've done as a district play, and we're very excited about the potential beyond what is evident there now. That offtake with Tesla, obviously a beautiful milestone, something like $1.5 billion in value to them, and I think it's just shone a light on, in this time of EVs growing at the rates they are, and the supply chain questions that I think lie. That is a beautiful question for the entire sector. I think just getting assets like that in the United States is quite unusual. So Shaun and Henri have done a remarkable job with that.
And given a lot of the OEMs want to start supplying or getting their supply from North America for EVs, is this something you think you might start directing more of your attention toward, battery metals?
I wouldn't say that more. I think we've actually done it from the beginning. So we've looked at everything from, you name it, on the range of lithium plays to cobalt to nickel to obviously copper. We've got copper and nickel exposure in the portfolio. I think that some of the more exotic niche metals, I think the challenge there very often is just how spiky the commodity price is, particularly when you're making longer term bets. But we do get visibility on a lot of those, and we are very active on them. It'll be our equivalent where Franco does well in gas. We'll focus and have been focusing on battery metals, and we continue to be active in pursuing opportunities there.
Shaun, let's move on to your balance sheet now. You have $600 million of available liquidity. You have zero debt. How are you going to allocate capital in the coming year?
Yeah, you would have seen on our IPO, we'd canvassed our investor base very carefully around the full spectrum of how do we think about dividend policy. Some saying, why pay a dividend? You're a high growth story. To others saying you should pay a significant dividend as a differentiator. We pegged our dividend yield at the time at about 1.5%, which is the highest in the sector. Our management team are 5% shareholders, so we view this as an important thing along the way to pay our investors as we continue to pursue our growth. And we've got ample firepower, as you've alluded to do so. We have no debt. We're generating about 30 million of cash flow a quarter at current run rates. And of course, you've seen our 5 and 10-year outlook that we've published, which shows the sort of fully funded growth beyond the record ounce growth that we've just demonstrated in this last year. So our highest and best use of our capital will always be to pursue accretive transactions. But you'll also see we've been very distinctive and discerning with that. Like, we're staying true to the model. We've looked at over 550 opportunities for the 17 deals and the 78 assets. We will maintain that discipline, and we'll be opportunistic. Like, we are not incented to do deals for the sake of it, but we've got dry powder, and we're happy to continue to deploy. And you've seen our track record. It's been a very steady cadence of deal execution along the way. So we'll maintain that balance, and we'd hope on the dividend front, our intention is to continue to demonstrate progression as we've seen the best in the sector like Franco do over time.
Shaun, as you mentioned on the onset, you do have 78 assets, 63 of which are explorers and developers. Is there one particular asset you're most excited for?
One is hard, right? It's like trying to choose one child. It's tough. So I think the first thing to orient people on is, of those 63, about 90% of those are in the United States and Canada. In fact, mostly in Canada. You've mentioned Tamarack. I'd say that that's one that we've been very excited about. We've got things in there like Eastern Barossi that have actually accelerated, or Calibre with the Eastern Barossi project. They're doing great work. We've got exposure to Queensway with some of the great work that they've done there. But if you think about it, our business was really focused on producing and near producing assets with some of these longer dated options as part of the portfolio exposure. And in a world where permitting isn't getting any easier, the timeframes from first discovery, I think on average to get to first production, maybe it's 15 years and growing. It's very important for us to make sure that exploration potential is very much locked in to the likes of what we've discussed with North Parkes, Cerro Lindo, and Buritica. So Buritica would probably be one I'd single out, where they've essentially almost returned our investment of 100 million that we made 2 years ago alongside Newmont. And they're just starting to ramp up that multi-million ounce reserve. That land package that we're exposed to there, the multi-million ounce reserve is on 0.18% of the land package, and there's so much exploration, it's open at depth. I think that's one I'd probably single out at a time where they've already gone through commercial production, and they're already going from 3,000 to 4,000 ton a day this quarter, or certainly in the first half, and in COVID are expanding beyond design capacity. So we're really excited about maybe that as very near-term opportunity that we're seeing manifest for our investors.
Shaun, as we wrap up, what can investors expect in terms of news flow from Triple Flag in the coming months?
Look, I think you've seen our recent throughput. We'll publish our financial results, which we're looking forward to in February, and issue our 22 guidance. But importantly, I think it's just demonstration of, as a new issuer, you've seen the virtual mine tours. We need to showcase the quality of the assets and really the performance of this management team and the quality of this portfolio. And we'll continue to do more of the same. We see that the most valuable businesses in the sector have that mature predictability to it, plus the opportunity with these catalysts to come. And I think that's really what we've got, and our job is to demonstrate more of the same.
Shaun, you're currently listed on the TSX. Can we expect a US listing sometime in the near future?
I think that's a near certainty. It's an obvious move. All our large competitors have followed that path. Our window opens up in May, and you can expect us to look to do that.
Shaun, that's a great overview of the Triple Flag story, and I want to thank you for sharing it with us today. To all of our viewers, if you have any further questions for the Triple Flag management team, send us an email to info@bloorstreetcapital.com. Once again, Shaun, thank you.
Thanks, Jimmy.
Hi, Randy, and thank you very much for joining us today. How are things in Vancouver?
Fantastic, Jimmy. Always a pleasure to talk with you. And yeah, no, things are going great here in Vancouver and in Wheaton. So
Glad to hear it. Randy, 2021 was a busy year for you and your team, having closed on 5 deals worth over $1 billion. And in early 2022, you've already announced another deal. And I want to go through these deals in detail. But before we do that, why don't we just start with a brief background or overview of Wheaton Precious Metals for those viewers who might not be familiar with the company?
Sure, Jimmy. Wheaton Precious Metals started off as Silver Wheaton back in 2004. We created the streaming business model, which is very unique and actually creates a lot more value for its stakeholders all the way across the board. So we don't actually operate mines. What we do is supply upfront capital for a portion of the byproduct, typically non-core byproduct precious metals production. And so we've built up to quite a substantive company. You know, our production last year, pretty close to 750,000 gold equivalent ounces, and lots of acquisitions, lots of business. I mean, our business is supplying capital to the mining industry, but we supply that capital for access to and exposure to some of the best copper and lead, zinc, and silver from gold mines and so on, and gold from nickel mines and so on. Some of the best mines in the world, and so. Well over 30 mines now delivering metal to us, a whole bunch of new development projects coming on stream, and the mining industry itself constantly needs to be reinvested into, and we are a very, very competitive source of capital, especially in today's world, to help mining companies grow and also to give our shareholders exposure to high quality, long life precious metals production.
And Randy, what percent of your revenues come from gold and what percent comes from silver?
Well, it's an interesting question because we did start off as a silver-focused company. So for the first 4 or 5 years, we were 100% silver. But back in 2012, 2013, we made a significant shift into precious metals as a whole. And pleased to report that for the last few years, we're now producing more gold than we are silver. So currently, we're a little bit over 50% gold, a little bit somewhere around the mid 40s for silver. We've got a little bit of palladium production, and a little bit of cobalt production from Voisey's Bay. The palladium that we get is coming from the Stillwater mine in Montana, and then a little bit of cobalt from the Voisey's Bay operation. And of course, we've just signed a recent deal here last year where we should see some platinum production coming from Generation Mining's Marathon project in a few years. And so, but still, dominant gold, but still very, very strong silver contingent too.
Randy, as you mentioned, 40% of your revenues comes from silver, and therefore you have a great understanding of this market. And silver has been underperforming gold in recent years. Do you think part of that reason might have to do with the fact that gold and base metal producers are producing a lot of silver as a byproduct and therefore dumping it on the market?
Nah, it's overall worldwide, silver production has actually seen its peak. It's actually come off of its high levels of production. So that includes all the byproduct production that's out there. So there's no doubt there's a lot more silver coming as byproducts. Over 75% or around 75% of silver is produced as a byproduct. It's always been in that 70 to 75% range. And as we see copper mines starting up with high copper prices and lead zinc mines and nickel mines, we're starting to see more and more of that byproduct silver. But that's countered by the fact that there's nowhere near as much primary silver mines out there. And the primary silver mines that are out there are getting old and tired. We just don't see a lot. And it's one of the reasons why we expanded into the precious metal space, is we were running out of opportunities to invest into the silver space. There's just not as much out there. And so I think silver has always lagged gold, but then it outperforms. And we've seen that numerous times. You go back and look at every precious metal bull cycle that we've ever seen, and silver has always lagged. I will say silver does have higher beta, higher volatility than gold. It's a much smaller market, and so that's why I think it's more susceptible to market shifts and market momentum and such. And so, we're still very bullish on silver. It's got so many attributes to it. I always chuckle at this. I'm the chair of the World Gold Council right now, but my favorite metal is still silver. It's just got so many other attributes to it beyond gold. It's a precious metal, so it works as a store of value, but it's also got so many applications in industrial world. And to me, I honestly call silver the real green metal.
Great insights, Randy. Thank you. So let's move on to your portfolio of assets. Before we dive into the new additions to your portfolio, why don't we first have a discussion on the more meaningful assets in your portfolio in terms of NAV, beginning with Vale's Salobo mine, which is located in Brazil. Why don't you provide an overview of this asset and also give us an update on what's happening in terms of phase 3?
Well, Salobo is our largest asset. There's no doubt. It's one of our highest quality assets. It did have a pretty tough year in 2021. They are working their way through this phase 3 expansion, but they did have some challenges with conveyors and some slides and stuff like that. Or one landslide close to the conveyor way, the new conveyor way and such. So they had a pretty tough year in 2021, and the phase 3 in dealing with COVID the completion date has been pushed out towards the end of 2022. But we are very excited. At the same time, they did a bunch of additional drilling. We saw those additional resources report in and reserves report in. So this deposit is a very, very long life deposit. It's a very high grade deposit, copper gold. We get 75% of whatever gold comes from this mine. And so we are quite excited about phase 3 coming on towards the end of 2022. And we're even more excited about the fact that Vale does continue to discuss, they haven't committed to it yet, but we think it's coming, is a phase 4 expansion at Salobo. And the loose conceptual date that they've got for phase 4 coming into play is probably 2028. And so, the timing works in terms of the finishing off phase 3 and again increasing it. So this phase 3 is going to be a 50% increase in throughput capacity. With that higher capacity, the cutoff grade will be dropping a little bit, so we're not going to see a 50% increase in gold production, but we will see a good increase in gold production from Salobo as it moves forward. So it's a great asset to have as part of our, it's our flagship asset. Had a little bit of a tough year in 2021. Fortunately, a bunch of other assets stood up. Peñasquito and Antamina stood up and delivered additional, outperformed to compensate for some of the weakness that we saw at Salobo.
So let's discuss Newmont's Peñasquito mine, which is in Mexico, and it brought in 2 million ounces of silver to you in the last quarter. Provide an overview of this asset and also give us an update on how that mine is doing.
Well, Peñasquito was, of course, originally a Goldcorp asset that was built and running, and that's when we signed the stream. Newmont took over a couple of years ago, and I have to say they've done a great job of just getting the mill fine-tuned. Its recovery rates are higher than we've ever seen. The grades were higher than we've ever seen. Dramatically outperformed. We saw really good production from Peñasquito last year. As I said, it kind of outperformed to compensate for some of the misses we had at Salobo. But a good, strong asset. I just have to say Newmont has done a really good job of getting this asset up and running, of dealing with community issues and getting it behind them, and just the asset is performing better than it ever has. And so we're quite excited. They are doing a bunch of drilling. They've had some good exploration success in the area, so we also see the potential for that mine life to be extended with some of this exploration success that they've wrapped in. So really, really happy with the job that Tom Palmer and the Newmont team have done at Peñasquito.
That's a great overview, Randy. Thank you. So let's move on to your more recent deals. You recently announced the streaming deal with Adventus for $175 million on its Curipamba project, which is in Ecuador. Take us through the highlights of this deal.
Well, it's a great asset. We've known Adventus for a long time. We became an equity shareholder in them a couple of years ago, and with that came some rights that allowed us to be the streaming partner as moving this thing forward. Curipamba is a good, strong, high-grade skarnish type deposit that's got some fantastic grades, which is one of the things that really drives us. We always look for high margin assets. We want to make sure that our partners are profitable. That's the most important thing. We've got this overlying mantra at Wheaton: the stronger our partners are, the stronger we are. So this one is a very high margin project. Adventus, the team, Christian and the team at Adventus, really strongly focused on delivering in terms of making sure that they work with the community. They've got an excellent track record. They've got a lot of good local partnerships within Ecuador. So really excited about moving forward with this one.
And Randy, you mentioned you're an equity holder in Adventus. Is this common practice, or was this just a one-off?
No, we've, all the way back to the very early days of Silver Wheaton, we've always looked at equity as being one way of getting our foot in the door, so to speak. Being a supportive shareholder, always helps when it comes to a competitive process in terms of earning a stream. And so we've long had a pretty active role on the equity side. It's not our business, but it's a way for us to get our foot in the door and help these companies grow.
Another deal that was announced in late 2021 was the $240 million streaming agreement with Generation Mining on its Marathon project in Ontario. Can you provide an overview of this asset, please?
Yeah, Marathon is a very interesting one because it's been around for quite a while. It's had a number of different owners. Generation picked it up off of Sibanye-Stillwater. Sibanye is not a mine building company. They acquire operating mines and sort of fine tune them. And we've had that direct experience with Sibanye at the Stillwater mine where we get gold and palladium. So anyways, the Marathon project, this one was a very unique one because we kind of went into it a little bit neutral, so to speak, just because it's been around for such a long time. But the more we looked at it, the more we really liked the project. It's got good, strong community support. They've just signed an agreement with the local First Nations group there to a support agreement, and so it's a team that again looks like it's got itself a really good asset that has good high operating margins. It's got power lines that run right across the property. It's got a very, very supportive community. The Trans-Canada Highway goes right beside the property. So it's in terms of infrastructure and access in this mining industry, we typically see so many challenging locations to build. This one's just about got everything it needs to go forward. So it's a good, strong project. We're going to see gold and platinum from this one, and really looking forward to partner up with Generation on this asset.
Recently, you acquired an existing gold stream, which was held by New Gold in the Blackwater Gold Project in British Columbia, and you also entered into a new agreement with Artemis Gold on the silver production. Provide us with an overview of this transaction, please.
Blackwater has been a project we've been watching for quite a while, and of course, New Gold, when they sold the asset to Artemis, kept a stream on it, and so we've been sort of watching that stream and trying to keep an eye on. We know that New Gold is much more focused on being a mining company versus a streaming company. So at some point they were going to crystallize the value of that stream, and so it helped that we had a good, strong connection with Artemis. Stephen Dean is we've known Stephen for a long time and followed his successes. And so, when he approached us in terms of looking for capital to help build this, we figured that was an inside track to help us also acquire that gold stream from New Gold. So it was one of the more interesting exercises we've ever done because the silver stream had New Gold had a ROFR on the silver stream, but Artemis had a reverse ROFR on the gold stream. And so it was an interesting negotiating process to sort of work our way through the whole cycle and sort of kick off the silver stream to ultimately acquire the gold stream at the same time. But combined, we've now got both the silver and the gold stream on this Blackwater project. Stephen Dean's moving it forward again, good, strong community support. He's got an excellent track record in terms of putting these things into production, close to infrastructure, good access to grid hydroelectric power here. And so again, some of the cleanest, greenest gold and silver that'll be mined, one of the better assets out there. And so we're quite excited to bring this one forward.
Randy, that's a great overview of your various assets. And now I want to move on to your balance sheet and discuss liquidity. How much liquidity do you have to allocate toward deals?
Plenty. I mean, in 2022, we should be very close to $1 billion in cash flow. We were pretty close to that in 2021, and so we in 2021 was the first year that first year in a long time we actually paid off our debt. We have a $2 billion revolver that's available for us at very, very attractive interest rates. And to be honest, we've been working inside that revolver acquiring assets, but our cash flow has now caught up to us, and we are now debt free. We've got good, strong cash flows coming in, and we've got a lot of commitments now over the next while, but to be honest, we're still generating more cash flow than we've been able to put back into the ground. And so it's an interesting dynamic because for us, if we can't put it back into the ground, we will grow the dividend and return it to our shareholders through that dividend. And so it's as the balance sheet gets stronger, it's going to come to a certain point where we're just going to have to amp up the amount of money that goes back to our shareholders through that dividend side. So, but we're still working as hard as we can to try and put it back into the ground on high quality accretive acquisitions.
The last time we spoke, I think you said you were paying 1.4% on that revolver. Are you still paying that level?
It's still below 2%, so it's still very, very attractively priced. Yeah, it's a good, strong revolver. It's got a 5-year term to it. It's got a syndicate of banks, Japanese, North American, and European banks that provide that support, and so it's been a very effective tool. I'm quite proud of the fact that we haven't issued any equity, any shares. One of our track records, we've got an ATM in place, a $300 million ATM in place that we put in place a couple of years ago because we had a couple of large scale activity or opportunities out there we were working on and thought we might have to draw into that. We are the only precious metals company to have an ATM in place and not issue any shares into that ATM. We're very defensive about issuing shares, and I truly believe we may be to a point now where we never issue shares again, where we're entirely self-funded. We continue growing the company and delivering good, strong yields to our shareholders.
Randy, as we mentioned earlier, 2021 was a busy year for you and your team. You closed on 5 deals, and this was up significantly from 2020. Why were you so active in 2021?
Well, it's an interesting time. What we're seeing a lot of is anyone that's producing with relatively high base metal prices. We're seeing good, strong cash flows from any of the producers out there. But what we are seeing is that there's a lot of single asset companies that are trying to move their projects forward. And of course, they don't have the benefits of cash flow coming in from operations because they're still developing these single assets. And so when it comes to sourcing capital to advance these projects into production, they have a number of different options. But typically, if you go into debt, you can never finance it fully with debt. There always has to be an equity component. So now you have to look at equity. Where do you get that equity component? Do you issue shares? Well, most of those companies are trading at a substantive discount to their net asset value. Or you can do a stream where you actually get fair value for those precious metals and fund that going forward. And it's delivered strong value. We share that arbitrage with these operating with these development partners to move these projects into operation. And so, the track record has shown it all the way back to Capstone in early 2021. Every single company that we've invested into, their equity has outperformed on the heels of announcing the stream because it strengthens their balance sheet, and they're selling off a non-core asset as they're building their copper assets or their lead zinc assets. They're selling off a non-core precious metal to Wheaton, and for that, they get the benefits of that capital. They also get the benefits of the Wheaton stamp of approval. We are very, very diligent and very thorough in terms of how we study these projects, and we treat our brand very seriously. We respect it. We make sure that we truly do focus on good quality assets. We've got a very diligent technical team that tears them apart and puts them back together again. And so when you see our name on a project, it's got the Wheaton stamp of approval. And I think the combination of that has actually made streaming a very attractive option to a number of these single asset or earlier smaller scale companies that have a need for outside capital and need to tap the equity side. They can sell off some of their non-core precious metals byproduct production and deliver that. And so yeah, we've seen that really resonate well in the industry, and I think it's really helped our success.
Randy, the largest deal you've done to date was Salobo at $1.9 billion, and the 5 deals that you completed in 2021 were relatively smaller, all at under 500 million. And are there any $1 billion or $2 billion deals out there in the pipeline?
They're very early stage. Typically those larger projects are all owned by larger diversified companies, and those guys, those operators, those companies are awash in cash flow right now. And so we're just not seeing a lot of demand on that space. There are a few larger scale copper projects out there that we're very, very interested in, but they're pretty early stage. They're not going to happen within the next few months. But we do have a very, very healthy pipeline of smaller projects. The 400, all under 500 million, but there's a good, strong, healthy pipeline of these projects that we're reviewing. And to be honest, we put out, if you combine the Adventus deal, it was over $1.3 billion in the last 12 months. And I think over 60% of all the streams that were completed last year were completed by Wheaton. So we've definitely made our mark. We've got a good, strong team that's going in place, and an industry that likes working with Wheaton. And so it's, you know, we're in good position that way.
With all this additional competition in the royalty and streaming sector, do you find you and your team have to become more creative in finding new ways to generate shareholder value? And if so, how?
Well, you know, it's a business as any business. It's a business. You know, there should always be constant improvement. But I will say the one thing that differentiates streaming from the traditional royalty companies out there is the fact that streams are built on partnerships. They're built on relationships. It's a contractual partnership where we, the streamer, are supplying a bit of capital, but we also have this mentality about managing our portfolio. And that means maintaining a good, strong relationship with our partners as they grow and build. And we, as I said earlier on, we have an overlying mantra in our office that the stronger our partners are, the stronger we are. So we do everything we can to help our partners be stronger, because we know that in the end that pays dividends. It pays dividends on the project level, but it also pays dividends on the reputational level, and the fact that people like working with Wheaton. From a number of different fronts. We were the leaders in terms of providing communities, matching community support with our partners to try and strengthen their own capability of maintaining good, strong social license. We outperform. We are the #1 rated company in precious metals by Sustainalytics from an ESG performance perspective. In fact, even more proud, we're listed in the top 50 of 12,000 member database of cross-sector industries in the world. We're listed in the top 50 in terms of ESG performance, and a lot of that comes from the fact that we do everything we can to try and help our partners improve and be better. And that comes from, you know, strong community support. We are now exploring ways on the environmental side to try and move forward with decarbonization efforts for our partners, and trying to help them move towards, decarbonization as a whole, lessening the carbon load that we have as operations. It's all a matter of trying to find ways to help our partners be stronger. Technical ambassador programs, CSR programs, and now decarbonization support. It's all ways that deliver a strong response. I mean, we are a service industry, and as in the service industry, the holy grail is the returning customer. And we've got an excellent track record. If you look at our last 12 transactions, I think 8 of them have been with people that we had relationships with, and we've had previous streams with, and they've come back because they like working with us. And that's something that we take with great importance, is making sure that we have good, strong partnerships, and making sure that everyone that we work with is truly focused on making sure that we can deliver the best we can in those partnerships. And I think that's what pays off. That's what differentiates us.
Randy, as we wrap up, what can investors expect in terms of news flow from Wheaton Precious Metals in the coming months?
Well, I mean, as I said, we've got a pretty healthy pipeline of new opportunities coming down the pipe. Obviously, a lot of the acquisitions that we've made recently are development projects, and so we're going to see good, strong construction updates, good, strong growth. With the 5 to 10 year growth profile, I've already seen draft views of it. It is impressive in terms of what we're going to have coming on stream over the next 3 to 5 years, as all these projects and investments that we've made are coming on. It's gonna get us a goal. I've set a personal objective to be the first streaming/royalty company to get to 1 million gold equivalent ounces per year. As I said, last year we were right in around 750,000 ounces gold equivalent, and we're not far off with the growth profile. So we're going to continue to try and put our money to work, our strong cash flows into the ground. But if we're not successful in that, then I would say you'll see any surplus cash go back towards funding a stronger dividend over time.
Well, Randy, that was a great overview of the Wheaton Precious Metals story, and I want to thank you for sharing it with us today. To all of our viewers, if you have any further questions for the Wheaton management team, send us an email to info@bloorstreetcapital.com. And with that, once again, Randy, thank you.
Jimmy, always a pleasure. Thank you.
Well, that brings us to the end of our royalty conference, and I hope you found it informative. If you have any further questions for any of the presenting companies, or if you would like some research on any of the presenting companies, send us an email to info@bloorstreetcapital.com. Don't forget to subscribe to our channel, Bloor Street Capital, and hit that notification button so you can be kept up to date on future events. Once again, thank you for your support.